Hello everybody and welcome to the Coopersmith Review Course Crash Course for BUS 202, and that is Business Law. In this course we are going to get into business organizations, specifically all the various different types of businesses, and we're going to discuss them a little bit. We're also going to get into corporate finance, we're going to get a little bit into mergers and acquisitions, a little bit about securities rules, and finally we're going to look into some employment law. As you can see from the course objectives over here, we are going to be looking at various types of business formations. We're going to be looking at documents. We're not going to be focusing so much on the nitty-gritty of preparing the documents, but more on having you understand what these documents are. We're going to discuss a little bit about securities markets, a little bit about stock, etc. Our first topic is sole proprietorships and entrepreneurs. Sole proprietorships are the majority, believe it or not, of all business forms in the United States, and entrepreneurs essentially is anybody who starts a business. An entrepreneur forms and operates a new business by him or herself or with other people. You could have an individual that's an entrepreneur, you could have a company that's entrepreneurs, you could have a group of entrepreneurs, etc. Entrepreneurial forms of business, in other words, how you actually operate as a business, can include many different types of businesses. The first one we are going to discuss is the sole proprietorship. Then you have a general partnership, limited liability partnership, or the limited partnership, and a limited liability company. We're going to discuss each of these in turn, and we'll discuss the positives and the negatives. The one we're going to start with is the sole proprietorship. The sole proprietorship is simply where you open up and start operating. It's not the sort of thing that you need any formation in terms of forming a business. Now, if you have a store, or if you have even a lemonade stand, or pretty much anything you have, you may actually have to get government permission before you actually operate. In other words, if you want to open up a restaurant, you may need to get permission from the Board of Health, or you may need to get a license. If you start a real estate brokerage firm, you may need to be a licensed real estate broker. That's all completely apart from the issue of the business formation. But in terms of a business formation, a sole proprietorship does not require any actual formalities. You just open your doors and you start operating. You don't need to go to the government to get a license to operate a business. Again, depending on the type of business, you may need a license for that particular type of business, but in terms of the formation, in terms of your operating, how you're operating, a sole proprietorship simply means open your doors and start operating. If you have a garage sale, or if you have a lemonade stand, or if you, whatever you want to do, operating is simply a matter of advertising or going out and doing whatever you need to do. You are a sole proprietorship. If you make any money from royalties or from authorship or whatever, and you haven't formed any actual business formation, well, then you are a sole proprietorship. The business is not a legal entity, and that's the reason why it's the most common form of business organization in the United States, because many people that have very small businesses or only do a little bit of business, if you file an income tax return, this would be a Schedule C, where you report your self-employment income, and you may not even think of it necessarily as a business, but if you make money, congratulations, you are a sole proprietorship. I would venture to say that most people in their lives at one point or another are a sole proprietorship to at least one extent. So it's owned by a single person. Just open the doors and start operating. You can hire people. Just because you're a sole proprietorship doesn't mean you can't have anybody working for you. Many sole proprietorships do have people working for them. And for legal purposes, there really is no distinction between the individual and the business. As far as taxation goes, and as we go through the various types of business organizations, at each step we are going to look at the important things that distinguish this business type from other business types in terms of how they are taxed, in terms of how the owners are liable for various issues that come up, etc. Now, the taxation for a sole proprietorship is easy. All profits are considered personal income of the sole proprietor, and there's no separate entity of the business itself. That means, as I said before, when you file your income tax return, you file a Schedule C, which is self-employment income, and you report whatever income you made. or a loss. There are some limitations on losses, but generally speaking, if you lose money, you can take that as a deduction. So if you make a lemonade stand in your front lawn and people come to you on hot summer days and you give them ice and you give them lemonade, maybe you give them some ices, whatever you give them, and they pay you a couple of dollars, well, at the end of the year, you've made $1,000 and you've had $400 in expenses, so you've made a profit of $600. Well, that goes on your Schedule C of your 1040, and you don't even have to report it as a separate entity. It doesn't have to file its own tax return. You may have to describe the business, and on your Form 1040, the IRS actually asks you to put it within one description. You can write, Jane's Lemonade Stand or whatever you want to call it. You have to put it in a particular business category. They give you a whole book that determines what business category you are, and that one would probably be food service or something to that effect. But as far as taxation goes, there's really no difference between that and the person who's actually owning it. Liability, on the other hand, one problem with the sole proprietorship is the proprietor is fully liable for all corporate debts, which, makes sense. It makes common sense, really. If somebody chokes on the lemonade or somebody slips on a little bit of an ice cube that fell down from the lemonade stand and sues me or sues my lemonade stand, well, I am going to be personally 100% liable for whatever debts incurred by the company. If I went and signed a contract to a sugar distributor to deliver 100 pounds of sugar to my lemonade stand, well, again, that's me. For the same reason, there is no legal distinction between the owner and the business. The person is simply running a sole proprietorship. As we'll see later on, and the other business forms have some advantage when it comes to liability and have some differences when it comes to taxation. The advantages of a sole proprietorship are simple. You have total control and simplicity of formation. It doesn't cost a dime to form. You just open your doors and that's that. You have total control over it. You don't have to worry about going to a board of directors or going to a managing partner or anything else. You just start operating. What are some of the disadvantages of sole proprietorship? In other words, why do people become more complex and more expensive forms of business, like the partnerships or corporations or other things we are going to discuss? Well, number one, difficulty in raising capital. If you want to raise money to run your lemonade stand. Now, lemonade stand probably is not going to cost that much to run. Maybe you need a little bit of cardboard to put up your stand and, some lemons and some water and some sugar and some ice cubes. Doesn't cost that much to actually run. But if you have something more complicated, like you want to hire a couple of developers to work for a year to build an iPhone app, it's going to cost you a couple of $100,000 to pay salaries to build or to rent office space or whatever it is, you really have to come up with that money on your own. If you don't have that kind of money in your pocket, you can go to the bank and get a loan, but you can go get a business loan. But again, there's no real special shortcut. You got to raise the money somehow. We'll see with corporations, you can sell stock. You can sell parts of the business. But raising capital is not that easy when it comes to a sole proprietorship. You've also got unlimited liability for the owner and the business debts. As I said before, if there's a problem and somebody gets sued or there's some level of liability, the owner will be 100% liable, and there is very low liquidity in the ownership of the business. If you want to sell the business, just like any other business, you can sell it, but it's not that easy to chop up the business and sell individual shares and get investors. If you do want to do those things, which many sole proprietorships do eventually want to do, sell shares of the business, you're probably going to have to then turn it into some other form of business, like a partnership or an LLC or a corporation even. And of course, by the way, you can switch back and forth. If you have a sole proprietorship, you can turn that into a corporation by just forming a corporation. You're not locked into any one of these particular business forms. So many businesses start as a sole proprietorship, and then after a while they're formed into partnerships when other people come on, and then maybe LLCs, and then eventually they become corporations. That's fine. Let's take a look at some of the other slides. Again, some of this is a little bit of repetition. Some advantages of sole proprietorship we discussed. Low cost of formation. The owners can make all the management decisions. You can have employees. That's fine. When you're talking about tax rules, of course, you may have special tax rules as an employer. You may have to send your employees W-2s. You may have to send independent contractors 1099s, and all that other good stuff that's a little bit beyond the scope of this course. But that is certainly something you do have to be concerned about. But in terms of the profits, it just goes on your personal 1040. Sole proprietorship owns the whole business, has the right to receive all the profits. You can sell the business if you like without anybody's permission. I mentioned before it's not that easy to sell shares of it, but if you want to sell the whole business, all you have to do is make a contract and have somebody agree to buy it, and you agree to sell it. What are the disadvantages? Well, again, as we discussed before, access to capital is limited to the personal funds, plus whatever loan that you can contain. You're legally responsible for the business and personally liable for any tort that is committed. Creation of a sole proprietorship is simple. There are no formalities. There are no federal or state government approval to form a sole proprietorship. But again, depending on the nature of the business, you may require some sort of a license to do business, depending on what it is you're actually doing. The liability, which we briefly touched on before, and we'll get into a little bit more now, the liability of a business includes, number one, the risk of loss of the business. If the business doesn't do well or the business fails, well, that's 100% your problem. It's nobody else's problem, as it would be in the corporation. The proprietor has unlimited personal liability. If somebody wants to sue the business, you and you alone, the proprietor alone, is going to be completely liable. And the creditors can recover claims against the business from the sole proprietor's personal assets. If they sue the sole proprietor, well, then the sole proprietor's house and other assets may be in jeopardy. And as you can see from this little diagram over here, the sole proprietor is really the entire business. The sole proprietor will owe debts or obligations to a third party with whom they do business. And if the third party owes the sole proprietorship money, again, the sole proprietor has the personal liability, is the person who would bring an action, or the person who is owed to the same extent. In other words, the sole proprietor, really the point of the entire first lesson is that the sole proprietor is the entire thing, is the entire business, start to finish. After the sole proprietorship, our next major form of business that we're going to discuss is the general partnership. General partnership is a very simple business form. It's maybe a little bit more complex than the sole proprietorship, but not much. It's a voluntary association of two or more people that carry on a business for profit. If it's non-for-profit, they would be a different type of business entity. It creates rights and responsibilities that we will discuss between the partners and third parties, and partners are personally liable for the debts and obligations of the partnership. If the partnership has a problem and gets sued, then each partner is personally liable and can have his or her own personal assets seized in some sort of a lawsuit, which is one of the disadvantages of this method of business as opposed to some of the ones that we're going to see later on, like the limited partnership or the LLC. The general partnership has only one type of partner, and that is the general partner. In this example, this chart, you've got 3 general partners here. Could be 5, could be 3, could be 2, could be 100. Doesn't really matter that much. They make agreements with third parties, and the general partners are liable to each other to, as we'll see later on, to pay back their personal investments and in case they get sued, but they're also liable to any third party. If the general partnership makes an agreement with the third party, each of the general partners is liable to that third party if later on there's a lawsuit or some sort of a damage that is caused. And the partnership is governed primarily, and most states have adopted this rule, and this rule is called the Uniform Partnership Act. The Uniform Partnership Act is a model act. A model act means a series of rules that is written by an expert in a particular area that they hope that states will take and adopt the rules that they write, and I believe most states have adopted the Uniform Partnership Act, and it covers problems from, or not necessarily problems, but situations or questions that arise from formation, operation, dissolution, all those things. The general rule is that all of these types of rules that are established by the Uniform Partnership Act can be changed by agreement. If the parties agree to something in terms of how their partnership is governed, they can agree to pretty much anything they like. The Uniform Partnership Act is generally there to establish default rules as to what happens if there actually is no agreement. The theory of partnership, in other words, how partnerships are viewed, is based on the entity theory, which means that the partnerships are separate legal entities. Now, when it comes to a corporation, as we'll see later on, a corporation really is a separate legal person. A partnership is not really a separate legal person. A partnership really is the sum total of its partners. However, from the Uniform Partnership Act perspective, it helps to look at it as though it were a separate entity. And a partnership has relatively simple requirements. You only need a voluntary association of two or more persons, and those could be corporations. Two corporations can form a partnership that's sometimes known as a joint venture that we're going to discuss a little bit later on in the course, briefly in the chapter on franchising. You could have two corporations that form a partnership. They carry on in business as co-owners. All partners have to agree to participation, otherwise it's not a partnership. They don't necessarily have to be equal partners, but they all have to be part ownership. And it's for profit. Here's a summary of some of the issues regarding a general partnership. Again, it is a contract, so each party of the partnership has to have the capacity to form a binding contract. Each person has to be competent. Each person has to have the ability, maybe be an adult, be mentally stable, have the ability to establish a partnership in order for a partnership to be valid, because then that's like any other contract. A partnership is considered its own entity for some purposes, but primarily, as I mentioned a few moments ago, a partnership is the sum of its ownership parts, which means really the partnership is just A and B as the partners managing the business together. Partnership agreements can be oral, but in most cases, and the better suggestion is for them to be in writing, and they can even be implied. They don't even necessarily have to the parties don't necessarily actually have to have agreed for there to be a partnership. If two people just operate something together, they operate a lemonade stand together, even though they didn't actually say we're partners, for legal purposes they will be considered partners, especially if it comes to being sued. If we have A and B that are opening up a lemonade stand, and A and B are running the whole show together, and somebody gets hurt and wants to sue A and B says, well, this was never a partnership, I was just here to watch. But if B actually held himself out to the customers as being part of the partnership, well, then a court might say, we're going to consider you part of the partnership for purposes of liability, and that is sometimes known as partnership by estoppel, which is a legal term that essentially means that somebody is prevented from making an argument. In this case, B is prevented from making the argument that he's not a partner because he held himself out to the public as somebody who was running this business as well. Single taxation, unlike a corporation, which we'll see later on, there's only one level of taxation. When a partnership makes money, that money, the profits of course, if there are expenses that can be deducted, but the profits are considered profits of the partners, and the partners have to put their profits on their own income tax return. Similar to a sole proprietorship in terms of liquidity and capitalization, it's very illiquid, hard to sell shares of a partnership. You can't really sell shares of a partnership. You'd probably, if you want to add new partners or take away partners, you might have to we have to change the entire structure and make a new partnership agreement. And it's very unstable, as I mentioned a moment ago. If any partner leaves the partnership, the whole partnership dissolves. Now, it can be reformed, but it's certainly not the type of entity that you want if you want people to be able to sell their shares of the business relatively easily. Our next issue here is some of the default rules that are relevant to partnerships. In other words, these are things that under the Uniform Partnership Act will apply unless the parties agreed to differently. The default rule is that each partner has an equal ownership. So if you have 3 people running a business and you didn't specify otherwise, each one will own 1/3 of the business. So if you're in a partnership and you invest more, or you want to establish that you are a majority owner, you'd better say so. If you don't say so, you might be prevented from doing so later on. That's very important. Upon dissolution, when the company goes bankrupt or the company stops operating for whatever reason, it doesn't have to go bankrupt, it could be doing very well, but it dissolves for whatever reason. First, the debts get paid off, then the capital investments get paid back. In other words, each partner gets back what he or she put into the partnership, and then the leftover is split equally if it's owned equally, or if it's not owned equally because they agreed on a different structure of ownership, then it's split proportionally. If I own 50% and you own 50%, then it's 50-50. If I own 40% and 2 other people own 30% each, well, then I get 40% of the leftovers. Evidence of a partnership. Again, usually when we're talking about trying to sue one of the partners for debts of the partnership, which is where this becomes important, there could be prima facie evidence, which means evidence on its face, clear evidence that you don't really need any interpretation for, simply receipt of the share of a business profits. If somebody gets a share of the business profits, well, it's obvious that person is a partner. Or, even without that, you can still prove the existence of a partnership by an agreement to share in the profits and losses and the right to participate in management. Even if the word partner is not used, if you can show that the parties agreed that they were going to manage it together, or that they agreed that they were going to split the profits, well, then you can use that as evidence that there is a partnership. Those are all cases in which there's not actually a partnership agreement. Where there is a partnership agreement, obviously that controls. And that's the sort of thing that could be in writing, or it could be oral. It's recommended that it's in writing, and anything can be put in there. If something is not put in there, then you would have to look to the Uniform Partnership Act to fill in any gaps that did not occur in the agreements. And the Uniform Partnership Act mandates, which means says, the right to an equal share in the profits and losses, again, unless the agreements provide otherwise. However, one little caveat is that if the agreement establishes a different profit-sharing arrangement, well, then that will be the assumption is that that will apply to losses as well, and vice versa. So normally if there are 3 partners, A, B, and C, well, the assumption will be that the losses are 33, 33, 33, and the profits are 33, 33, 33. But what if there's an agreement that says A has the right to 50% of the profits and B and C 25 each? Well, then the assumption will be the same thing as losses, that the losses will also be 50, 25, 25, and the same thing is true the opposite. Again, the theory being that if the division of losses or the division of profits is stated, that is the assumption in terms of how much of the partnership each person actually owns. In terms of managing the partnership, there is also the question of compensation. What if one of the partners, A, let's say, goes out and starts the business and goes out and spends a year and spends, 1,000 hours of time working on the partnership business? Is that person entitled to compensation? Well, the general answer is no, unless it is specified in the agreement. So if you're going to work on behalf of your partnership, if you and a few other people have a partnership, and you're going to work your head off trying to get the business going, well, then make sure that there's an agreement, preferably in writing, among the partners that you're entitled to reasonable compensation, that you're entitled to get something more than just your share of the profits. If you don't, the assumption will be that you're doing it out of the goodness of your heart, that you're doing it because you're a partner and you're trying to make the whole business do well, but that you're not entitled inherently to a salary. On the other hand, indemnification is automatic. So if I spend $500 on legal fees to get the articles of partnership written, or if I spend $2,000 on an agreement, if I actually lay out money on the partnership business, the assumption is that the partnership will pay me back. Then there are some other rights that are relevant to partnership. There's the right to return of loans and capital, which means if a partner lends money to the company, or if a partner contributes money to the company, the assumption is that eventually the partnership will have to pay that person back, as we just discussed. And finally, we've got the right to information. The right to information means, as it sounds, is that partners have the right to true and full information from any partner regarding anything that affects the partnership. If I want to see the partnership's tax returns, or I want to see where the partnership spent its money, if I'm a partner, I have the right to that information. The other partner, whichever partner does know the information or does have the information, has a responsibility to provide it. And partnership books have to be kept at the partnership's principal place of business, and the partners have the right to inspect or copy the records anytime they so choose. Okay, and the next thing we're going to discuss are responsibilities among the partners after we've finished already discussing their rights. Okay, these can be referred to, and this is something that's going to be important with regard to corporations later on. Pretty much all of the same rights that you're going to see here apply to corporate directors and corporate officers as well. So keep that in mind as we discuss this, that we're talking about it in the partnership section, but all this stuff is really going to be relevant to businesses in general, to corporations. And that is the duty of loyalty, the duty of information, the duty of care, and the duty of obedience, which is not quite as harsh or as all-encompassing as it sounds, but we are going to discuss it in a little bit of detail. Okay, let's first start with the duty of loyalty. And the duty of loyalty means a partner owes a responsibility not to act adversely to the interests of the partnership, or, as we'll see a little bit later on, the corporation as well. That means, really, as you can see from the last bullet point over here, in the case of a conflict between partnership interests and personal interests, the interests of the partnership, the interests of the corporation or the interests of the business come first. Now, that of course doesn't mean that you're not allowed to negotiate for a higher salary with your company because your company would be better off giving you a lower salary. It doesn't mean any of that, of course. It does have some specific ramifications, and those specific ramifications are as follows. We've got a partner cannot self-deal with the partnership without permission. That means if you are a partner or you are a corporate director and you own an element of the company, you cannot make a deal between your own private interests and the company interests. For example, if you own a house and you say, well, hold on a second, I have an idea. I need to sell my house, I need to move, so why don't I sell the house to the partnership? Or why don't I sell the house to the corporation that I am a director of, or the partnership of which I am a partner? That is called self-dealing, and it is a breach of the duty of loyalty unless the other partners and the other corporations, the other corporate directors, if it's a corporation, know of the fact that you're making this self-deal. You're essentially making a deal with yourself in your own personal capacity with the company. And also, it doesn't say so on the slide, but there also is a fairness requirement. There's the idea that the deal has to be fair to the partnership. If I make a deal where I sell my house to the partnership for $500,000 and my house is only worth $300,000, a court can actually strike that down. That would be considered a breach of my duty of loyalty to the company. Number two, you cannot usurp a corporate or partnership opportunity. And that means that if in the course of my doing business for a partnership, I am presented with an opportunity, I cannot take it for myself. I have to give it to the partnership. For example, if the partnership is buying a building, and while I'm working on that deal, I find out that the neighboring building is also for sale. Let's say the neighbor comes up to me and says, hi, I know that you're working for Jim and Joe's partnership and working to do this to buy this building. Well, I've got the next door building that's also a good building, and how would you like to buy that from me as well? And if I say, well, I don't want to do it on behalf of the partnership, I don't want to do it on behalf of Jim and Joe, but I would like to do it in my own personal capacity. I'll give you the money. That is usurping a partnership opportunity. That is taking an opportunity that you found out about and that you got in the context of the business that you were doing for the company, and you're taking it for yourself. That's a breach of the responsibility of loyalty as well. Compete with the partnership without permission. If the partnership, for example, opens up a bunch of coffee houses, and I decide to open up my own coffee house next door or down the block from one of the company's coffee houses, I am essentially competing with myself. Now, there's nothing inherently illegal about competing with yourself or competing about anybody else, but if you have partners in one venture and you have different partners in the other venture or no partners in the other venture, you're essentially violating the responsibility you have to your first partners. We've got a series of partners. We've got partners, let's say A, B, and C, and I'm A, and then we have a coffee shop, and then next door I open up my own little coffee shop. Well, then I'm violating my responsibility to B and C because I am essentially competing with B and C. Unless, of course, B and C give me permission. Make secret profits from partnership business, very similar to the idea of corporate opportunity, but this could be, let's say, getting kickbacks or getting gratuities if I steer business. For example, if I make a deal with a real estate agent, well, if I steer the business to you, you'll pay me a certain amount of money on the side as a referral fee. Now, that, of course, sidesteps the issue of whether you can do that in the first place. Let's put it this way. Getting a kickback in order for steering business towards somebody, getting kind of a referral fee, can be okay in some circumstances. In some circumstances, it's illegal. So then, you can actually go to jail for doing that in some cases. But in many cases, it is okay. In many cases, it's fine. For example, if a real estate agent wants to give you a gift in exchange for referring a client or in exchange for using that particular agent to buy a house, there's nothing inherently wrong with that. But even in cases where it's okay, if you are getting money in your own personal capacity, when the business you were doing was on behalf of a partnership or on behalf of a corporation, that is a breach of your responsibility of loyalty. Disclosing confidential partnership information. If you have information that the partnership ought to stay secret, the partnership in terms of how much money the partnership has, in terms of what its plans are for the future. If there are things that are not publicly available information, if you disclose that information to a third party, you are violating the responsibility of loyalty. Misusing partnership property or other breaches of fiduciary responsibility. This word fiduciary is the idea that you owe a responsibility to your partners to act as somebody that is trusted. Fiduciary really just means that you're acting in a way that is helpful to your partners, is helpful to the other people that are in your business. And if you act in any other way, even though we've already discussed some examples, the idea of usurping a corporate opportunity, competing without permission, making secret profits, disclosing information, these are all examples of the duty of loyalty, but the point is this is not a limitation. It's not like these are the only possibilities of breaching the responsibility of loyalty. There are other examples where responsibilities of loyalty could be breached, and if one of these arises, even if maybe it hasn't been thought of, if it's not on this slide, it doesn't matter, anything that can be construed or can be looked at by a court as being a violation of the responsibility that you have to your partners or to your corporate shareholders as a fiduciary, in other words, as a trusted member, as a trusted representative of them, that can also be considered a breach of the duty of loyalty. So in other words, the overall theme is you owe a responsibility to do things in the best interests of the people with whom you're partners. Then you've got the duty of care. Duty of care is a responsibility that you owe to your partners in a way that means that in addition to being faithful and loyal, you also have to show some level of competence. If you're handling your partner's money and you put it in a non-FDIC insured account or you invest it in something that's reckless and the money is lost, well then you may be found to have violated the duty of care. And if the partners lose money because you negligently invested their money poorly or you negligently allowed their money to be lost for whatever reason, then you could be subjected to a lawsuit for a violation of this duty of care. Then there's the duty of information. The duty of information is a simple one. You, as a partner or as a managing partner, again, as a corporate director or a corporate officer, or anybody who is conducting business on behalf of a partnership or on behalf of a business, have a responsibility to share whatever information you possess. That's relevant. Obviously, you don't have to share everything, but if it's relevant to the business, if it's important, if it's the sort of thing that the other party ought to know about, well, then you have a responsibility to share that information with the people that are with you, are in terms of ownership of the partnership or the corporation. There's no particular black letter rule in terms of exactly what information must be shared and what information doesn't have to be shared. It's the sort of thing that has to be looked at on a case-by-case basis. And if somebody is alleging a violation, if somebody is alleging that, well, you didn't inform me of this information, and therefore the person is suing you, well, then the court would have to look at, or the jury would have to look at, is this information that a partner normally ought to have? If it's the sort of thing that a partner normally ought to know, well, then failing to disclose that information could be considered a violation of the fiduciary duty that you have to your partners. And finally, you've got this duty of obedience. Now, duty of obedience doesn't mean you have to listen to everything your partners tell you. Your partners tell you to do something, well, you have just as much right to act on behalf of the partnership as your partners do. What it does mean is that if there is a provision in the partnership agreement, or if it's something that was decided by a duly consulted majority, sometimes if there are 5 partners, let's say, and the partnership agreement says that 3 out of 5 can make a decision, and 3 out of the 5 make a decision to sell a particular piece of property, and you don't. You decide not to do it because you think it's a bad idea. You're put in charge of this transaction, and you decide to sell it for a different price or sell it to a different buyer, even though you were outvoted. That is a violation of the responsibility of obedience. Obedience meaning that you have a responsibility to follow whatever is appropriate under the rules of the company. If you fail to act in this regard, of course, that could also subject, unfortunately, to a lawsuit. So let's continue with various other miscellaneous things with regard to partners and their relationship with the other partners and relationship with the outside world. Number one, of course, there is a right to an accounting. Accounting means a right for the financial information, a right to look over the books and make sure if one partner suspects that one partner has gotten too much, or one partner or that person has gotten too little, or there have been information that hasn't been properly shared, or for really whatever reason, each partner has a right to see the books of the company, to see the balance sheets, to see the income, to see the outflow, to see whatever money was made, to see whatever money was spent, etc. They can bring an action. Each partner can bring an action for an accounting. Either they can ask to see the books directly, or they can literally go to court and ask the court to force the other partners, whichever partner is actually taking care of the books and taking care of the money, to ask for a form of judicial accounting, in which they can review the partner's transactions and award each partner his or her share of the partnership assets. If the court believes that one party has not been paid appropriately based on the partnership agreement or based on the default rules, the court can order the parties to get paid what they're supposed to be paid. The next issue is this idea of tort liability. Torts, for those of you who may not be familiar, means when there's some sort of an injury suffered by someone, in this case by a third party. The question is, who is liable? And the answer is, everybody's liable when you're talking about a regular general partnership. Now, we're going to discuss a little bit later on how when you're talking about different types of entities, there's a limitation on liability. But generally speaking, when you are talking about liability, if the partnership commits a tort, in other words, if the partnership business is sued, let's say the partnership has a restaurant and somebody chokes on a foreign object that's in the food, or there's food poisoning that somebody gets, and the person files a lawsuit against the restaurant. Well, everybody is liable. All the partners are liable. Partnership is liable for the tortious, which means committing a tort, which means damaging acts of a partner, employee, or an agent. In other words, somebody who works in the restaurant or somebody who's hired by the restaurant, if they're working within the ordinary course of the partnership business. There's a general tort rule that if I own a business and somebody commits a tort, somebody commits damage while working on behalf of the business, I am liable. And that's the general rule when you're talking about a general partnership, and that is that the partners are personally liable for whatever happens in the context of the business. The way they are liable is sometimes known as joint and several liability. Joint and several liability is a concept that says each partner is fully liable for whatever injury there is. Now, of course, that doesn't mean that each partner has to pay 100%, meaning the person that's sued gets 400%. If there are four partners, A, B, and C, and D, and the victim at our restaurant suffers $100,000 worth of damages, that, of course, doesn't mean we each have to pay $100,000 and that the plaintiff walks away with $400,000. I mean, that would be very nice for the plaintiff, but that wouldn't make much sense. Instead, what it means is we're each liable for 100%, to the extent that if one of us is not around or if one of us has no money, then the others have to make up whatever difference there is. So if there are four partners and there's a $100,000 judgment, we would each owe $25,000. However, what if partners B, C, and D all skip town, or they have no money, or they can't pay for whatever reason? Well, then partner A would be responsible for the full $100,000. That is a concept called joint and several liability, and it applies in general whenever you're talking about two or more people that commit a tort. If you have two people that together beat somebody up or together, injure somebody through negligence, they are joint and severally liable, which means they're both liable for 100% of the damages. The normal rule would be that they split it and each pay half. However, if one cannot pay for whatever reason, or if one is beyond the jurisdiction of the court, if one, doesn't live in the United States and the court doesn't have jurisdiction over the person for whatever reason, then the other person partner who committed the tort, or in this case, the partner of the business, would be fully liable. So if you have three people that own a hot dog stand or three people that own a restaurant and a person gets injured and two of them can't pay for whatever reason, or two of them skip town, two of them there's no jurisdiction over, whatever it is, the poor third person is going to have to pay for the entire thing. That is the concept of joint and several liability, and it applies to a partnership. Then we've got the idea of contract liability. Well, if the business signs an agreement to order supplies, or to rent an office, or whatever it is, well, who's liable for that? And the answer is, all of them are, right? That's really the same rule with regard to torts. We just discussed that rule with regard to torts, and now we're going to discuss the same rule with regard to contracts. If the company duly signs a contract, the partnership orders an office, let's say 5,000 feet of workspace for a year for $100,000, well then that contract, all of the partners are individually liable for it. I think you can start to see why it's a good idea to have one of those other business forms that we're going to discuss a little bit later on, wherein you have a limitation on liability, wherein you have a situation where the partners are not necessarily fully liable each for the company's debts, because the default rule is that each partner is joint and severally liable for the entire debts of the company. There is one minor distinction between contract and torts liability. The third party has to name all partners in the lawsuit rather than just suing the company. You have to sue the people individually, and a successful third party can collect judgment against any or all of the partners. So again, here's a chart with some of the slight distinctions, but I can tell you in general that the rule is that you can sue any or all the partners, and of course the partners can fight amongst themselves to make sure that they split any debt equally. If there are four partners and there's a $100,000 judgment, well then they have to each pay $25,000. Let's say B, C, and D are out of town, or B, C, and D are run away and they don't pay the money, then A has to pay the entire thing, but then of course A can turn around and collect his or her what is called indemnification from the other partners. And indemnification means, well, like indemnify, like an insurance company. They get to get their money back. In other words, partner A can then turn around and sue partners B, C, and D each for $25,000 for their individual shares. What about an incoming partner when you're talking about debts that already existed before the partner comes in? We've got A, B, C, and D are partners, and they owe this judgment of $100,000, and then they take on partner E during the lawsuit. Either partner E doesn't know about the lawsuit or partner E does know about the lawsuit. The question is, what is partner E's liability? Is partner E liable for these what are called antecedent debts? And antecedent in this case means debts that occurred before E's interest in the partnership was established, or not? And the general answer, I think you probably could figure this out, is that the new partner is liable for prospective debts, in other words, liable for debts that come in the future. And of course, the partner can lose his or her contribution to the partnership if the partnership goes under, or if the partnership has to pay all of its money for a, for a lawsuit. However, the new partner is not personally liable for debts that existed beforehand. So, for example, while the partnership has a $100,000 debt, E comes in and pumps in $50,000 to the partnership as a new investor. Well, that $50,000, of course, now belongs to the partnership. And so that $50,000 can be used to satisfy whatever debts there are in the partnership. However, E cannot be sued personally in addition to that, for E's personal assets, for something that happened before E ever even got involved in the partnership, which I think is a fairly commonsensical, if that's a word, rule. So the new partner is personally liable for debts and obligations incurred by the partnership after becoming a partner, but not before becoming a partner. And finally, with regard to a partnership, we are going to look at dissolution, which means ending a partnership. Dissolution occurs when the partnership ends. That doesn't necessarily mean the business owned by the partnership ends. It just means the partnership relationship as it existed till now is being fundamentally changed or is being ended. So, for example, if there's a restaurant and A, B, C, and D, our people are running this, let's say this barbecue restaurant, let's say for argument's sake, the restaurant might still exist, but the partnership could be dissolved. The partnership could be dissolved either because it was only established for a limited time in the first place. Let's say the partnership was only established for 5 years. Well, then, of course, the partnership dissolved after 5 years, even if there's actually business being run by the partnership. Another example would be if a partner decides to opt out. A partner decides to withdraw. The general rule is, unless established differently by the partnership agreement, as soon as one partner withdraws, the partnership is considered dissolved. Or when there's a vote to dissolve. Sometimes the partnership could vote to change the structure of the partnership. That could be because it's not working out, or it could be because it is working out and they want to reform as something else. Instead of using a general partnership form, they want to become an LLC, or they want to become a corporation, or they want to become some other form of business. Well, the first thing you got to do is you have to end the previous relationship, end the general partnership. So what happens when you end a general partnership? Again, it could be because of a good reason, or it could be because of a bad reason, or anything in between. It doesn't necessarily have to mean that the entire business is coming to a crashing halt. Well, the process by which a partnership is ended is called the winding up. This is the process of liquidating the partnership assets and distributing the proceeds to satisfy claiming against the partnership, and then settling up, essentially, among the partners. Again, this doesn't mean that you're necessarily going to distribute the money. Maybe you're going to take the money and reform it into a new business entity, but the stage of winding up occurs whenever a partnership is dissolved, which essentially occurs whenever a partner withdraws or whenever the people in the partnership vote to fundamentally change the structure. Okay, so first thing you do is, what do you do with the partnership assets? Partnership's got a bank account, partnership has a plant, it has inventory, it has a store, it has intellectual property, it has whatever property it has. What do you do with that money? Well, the first thing you do is, if there are creditors, they get paid first. If there's a bank, if they have credit cards, if they took out a loan, whatever it is, they get paid first. Then, once you've paid off the creditors, assuming that there's money left, you pay the partners who are creditors. Sometimes partners lend money to the company. Well, they don't have first priority. Outside creditors have first priority, but then they've got next priority. Once that's done, you pay off whatever capital contributions there were. Capital contributions means the amount invested in the partnership by the partners. If, for example, you have A, B, C, and D, and A invested 100,000 into the partnership, and B invested 50,000, and C invested 20,000, and D invested 10,000, well, they might be equal partners anyway because maybe they have different levels of expertise. For whatever reason, they're equal partners. Still, when you're winding up, A gets his or her 100,000 first, and B's 50,000, etc. And then once they all get paid off, whatever's left over is now profits. Whatever's left over, the creditors have already been paid, loans have already been paid from the other partners, capital contributions have been paid, and now it's time to divvy up whatever profits there are. As we discussed before, just because a partnership is dissolved doesn't mean that it's necessarily over, that there's no more business necessarily going to be conducted by these people. You can continue after the dissolution if you like. You can even make a continuation agreement, which says, okay, after everything is distributed, or after some of the debts are distributed, depending on what the partners want to do, they can continue as a partnership with either new members or a subset of the previous members, etc. Or you can have the old partnership dissolved and an entirely new partnership created, or a new corporation created, or a new LLC created, or anything to that effect. If all the creditors are not paid off, if you're forming a new entity and you just didn't have enough money to pay off the creditors, well, then the old creditors, the banks, the credit cards, whatever it is, become creditors, which means people who are owed money by the new entity, by the new partnership. What about outgoing partners? And the answer is, of course, another logical rule. Just because a partnership is dissolved does not necessarily end the liability that already existed for that partner in terms of previous debts or antecedent debts, as we saw before. So if A, B, C, and D owe $100,000 because there was some lawsuit or because they signed an agreement to lease some space or for whatever reason, D decides to leave the partnership and therefore the whole thing is dissolved, that doesn't get D off the hook. If it did get D off the hook, well, then any partner who was in debt would simply dissolve the partnership and that would be it. D is still personally liable, and that personal liability is in the form of joint and several liability. So D theoretically could be on the hook for the entire thing, if A, B, and C don't pay their share. So just because D is leaving the partnership doesn't absolve D of whatever liability there was. Again, a fairly commonsensical rule that is really necessary in order to make sure that people can't simply get out of whatever liability they had. Next issue is, okay, let's say a partner dies. Well, what happens to his or her share? The default rule for a partnership, and this could be changed by the agreement, is what is called a right of survivorship. Now, there are really two different types of arrangements in this respect. Some types of businesses or entities, or you could write in the agreement that if one partner dies, his or her share goes to his or her family. That is called an arrangement where there is no right of survivorship. Right of survivorship means that the remaining account holders or the remaining partners would get his or her share. I mean, just to give you an example of how this would work when you're talking about a bank account, if a bank account has right of survivorship, so let's say you've got A and B have a bank account, a joint bank account, which has a right of survivorship. So when A dies, B becomes the sole account holder and B holds the entire thing. On the other hand, if they're holding assets in a way that there's no right of survivorship, well, then A's share doesn't go to B. A's share instead go to A's heirs, A's family, or whatever A's will says. So the default rule, unless stated otherwise, is that when you're talking about a partnership, there is a right of survivorship, but they could be changed by the agreement. You have to look at the partnership agreement, if there is a partnership agreement, and if the partnership agreement says there is a right of survivorship, well then if the first partner dies, it goes to his or her heirs. If the agreement says that there's no right of survivorship, well then if a partner dies, the assets or the partnership interests go to I'm sorry, if there is a right of survivorship, it goes to the other partners, and if there's no right of survivorship, then it goes to the deceased partner's heirs. Of course, after the death of the last partner, well, then it would have to go to the deceased partner's legal representative, like the executor, or really eventually to the family or to the heirs of the last partner, for the simple reason that there's nobody left. There's nobody left for it to go. Even if there's a right of survivorship, there are no survivors if the last partner dies. All right, let us take a look as we end our discussion of general partnerships, of an example of a winding up of a distribution. Okay, so let's take a look at an example, then we're going to look at the solutions for each of these examples. Bart, Lisa, and Maggie have a partnership with no written agreement, so we're going to look at the default rules, in other words, the ones that we have just discussed in the last few minutes. Bart contributed $500,000 to the partnership, Lisa contributed $300,000, and Maggie $100,000. If the partnership dissolves with $1.5 million in the bank and no debts, how much will each party receive? Second one, if there's no assets or debts, what will happen to the parties? Or D, what if there's $1.2 million in debts? What does each have to pay? Well, remember, the first thing that gets paid are the debts of the company. So and then the second thing, after the debts of the company, you have to give back the capital contributions. And the third thing, if the capital contributions are given out and there's still money left, then it's split among the partners. So let's take a look at each of these in turn. Let's take a look at number one. Partnership dissolves with $1.5 million in the bank and no debts. How much will each party receive? Well, here's our solution. Each partner has to get back his or her original capital contribution. Now, Bart contributed $500,000, so he takes the first $500,000. Lisa contributed $300,000, so she gets the next $300,000. Maggie gets her $100,000. Now, if you subtract, that's $900,000 paid out, so there's $600,000 left. That $600,000 left is now profit. So that profit gets split three ways, $200 to each. So if you have a calculator or you have a pen, you could write it out and see if you can figure out the same thing as the way I did it. But Bart has $700,000 altogether, his original $500,000 contribution plus the $200,000 in profits that were split equally. Lisa gets $500,000 altogether, her original $300,000 and $200,000 of the profits. Maggie gets $300,000, which is her $100,000 capital contribution plus her $200,000 share. What about number two? If the partnership dissolves with no assets or debts, well, remember the capital contributions are considered partnership debts. So the partners essentially have to contribute enough to pay the debts. There's $900,000 in debts here because the Bart is owed $500,000, Lisa's owed $300,000, and Maggie's owed $100,000. So that's $900,000 in debts. So of that $900,000, each party has to contribute essentially $300,000 to the pot, to the middle, so that they can each be paid back. So Bart put $300,000 in the pot, but gets to take $500,000 out because he's getting his $500,000 back. Lisa, of course, breaks even. She has to put $300,000 into the pot in order to pay everybody, but she gets her $300,000 back. And Maggie, of course, who only made a $100,000 capital contribution, has to pay $200,000 because she's got to put $300,000 in the pot and only gets $100,000 left. The third example, on the other hand, obviously this partnership hasn't done too well. The partnership has no assets and $1.2 million in debts. Who has to pay what? Well, if you think about it, there's really $2.1 million in debts, 1.2 in debts to the outside, and then 900,000 in debts within the partnership. So essentially, each person has to put 700,000 in the middle in order to make up that 2.1 million. Bart puts in 700,000 and then gets $500,000 back because that was his capital contribution. Lisa puts in 700,000 but then gets 300 back for a net payment of 400,000. Maggie's net payment is, of course, 600,000. And again, if you have trouble understanding what this example is, I would recommend maybe pausing it, go back to the original example, see if you can come to the same conclusion. I think once you understand that each partner has to pay for debts which include capital contributions, it should be fairly easy to calculate. Next, we are going to focus on a different type of partnership, and that is the limited partnership. The major difference between the limited partnership and the general partnership, which we just discussed, is that some of the partners in the limited partnership, namely the limited partners, A, take no part in the management, but as compensation for that, they are also not liable for partnership debts. That's the key about a limited partnership. The idea of the limited partnership, and the reason why the limited partnership was created in the first place, is that it was designed to keep the control, taxation, and simplicity benefits of the partnership, in other words, to not have to actually go to a corporation, but eliminate the problem of unlimited liability that plagues ordinary partnerships. In other words, in the old days, there was really just two types of businesses. There was the partnership, or I guess the sole proprietorship, if it was one person, and then there was the corporation. And the corporation had the advantage of unlimited liability, whereas the partnership had the advantage in terms, the corporation had the benefit of limited liability, which meant that the shareholders were not liable for corporate debts, whereas the partnership or the sole proprietorship had only single taxation, was only taxed once, and had more simplicity than a regular corporation. So the limited partnership was created to kind of be a little bit of a hybrid. Today we'll see there's probably a better hybrid called the LLC, but the limited partnership it does require a filing with the state. Unlike the general partnership, which we saw a little while ago, you actually have to file with the state in order to establish a limited partnership. And you have, in a limited partnership, two groups of owners. You've got the general partners. These are the people who essentially are comparable to the general partners or the regular partners in a general partnership. These are the controllers. They have unlimited liability, but they also manage the company. Whereas the limited partners are more like investors. These are people that have no management functions. They cannot actually run the business on a day-to-day basis, but they have limited liability, which means that they are not liable for partnership debts. Essentially, if you have limited liability, if you are a limited partner, your liability is the maximum extent of what you can lose is what you put in. If you put $50,000 to buy into the partnership, you can lose that whole $50,000 if the partnership goes belly up. But on the other hand, if the partnership commits a tort, if the partnership signs a contract, if the partnership gets some sort of a judgment or a debt, you are not personally liable. So really the most you can lose is what you put in. That's the whole idea of limited liability. A limited partnership, unlike a general partnership, is not automatically dissolved by transferring interest to a third party. When we talked about a general partnership, remember how it dissolved pretty much whenever anything happened. When a partner decided to leave, when there was a reorganization, pretty much anything caused the partnership to dissolve. Limited partnership is not quite the same thing. When you're talking about taxation, well, taxation has the same as a general partnership. Taxation, if you may recall, when we talked about a general partnership, occurs on an individual level when you're talking about a partnership. In other words, each partner has to pay tax on his or her share of the partnership profits. The partnership itself does not actually pay any of its own income taxes. Instead, the partners get a Schedule K1 from the partnership, which the partnership does file its own tax return. It's called the Form 1065. Then the Form 1065 kind of tells everybody what their income is, but the partnership itself doesn't pay its own income tax. Unlike a corporation is its own entity and files its own income tax return and pays its own income tax. But the partnership, on the other hand, is only taxed at one level, and that's the level of the individual. That's the level of the partners themselves. Capitalization, of course, which means getting money, is easier than in a general partnership because people can invest without working at the business or assuming liability. It's a lot easier to get somebody to invest and become a partner if you can say, don't worry, you're only going to have limited liability. Whereas if you have to tell a person you're going to be liable for debts, it's going to be much harder to get people to sign on to become partners. So limited partnership has that advantage. It's a little easier to get investors. Many of the other rules, as we're going to see, are going to be very similar to the general partnership. In fact, the general partnership rules pretty much all apply to the limited partnership, except for the distinctions that we already discussed, namely that some partners are only limited partners, they're going to have limited liability, they don't have management roles in the company, and the sale of one person's interest doesn't automatically dissolve the entire thing. There is a uniform rule, the revised Uniform Limited Partnership Act, or the RULPA, which is the series of rules that govern the limited partnership, which is of course similar to its counterpart for the general partnership, which is the UPA, the Uniform Partnership Act. So capital contributions, capital contributions means the money that you actually put into the business, that you invest in the business. And just like with the general partnership, these become debts of the company. The company's got to pay it back eventually upon dissolution. So these can be in cash, property, even services, promissory notes, pretty much anything that can be contributed to a company. Just like with a general partnership, there can be a partnership agreement. There doesn't necessarily have to be a partnership agreement, but there usually is. There has to be a certificate. Again, unlike a general partnership, which you can just start operating without any certificate, you do need to file something with the state, and that is the certificate. So there does have to be a certificate. And usually there will also be a document, and the document will set forth the rights and duties of the partners, the terms and conditions regarding the operation of the business, and terms regarding dissolution or termination of the entity. There are default rules. If some of these things aren't covered, then you have to look to the revised Uniform Limited Partnership Act. And the rules that we're discussing and that we have discussed so far are, generally speaking, the default rules. But if the parties want to make different rules, well, they can agree to pretty much anything they like. It's their agreement. They can do pretty much what they like. Here are some of the default rules. And that is, to start with, the uniform rule regarding profits and losses. And the rule here is very simple. It can do whatever the agreement says so, if the agreement actually specifies this. If there is no agreement regarding the sharing of profits and losses, then the Uniform Limited Partnership Act provides that profits and losses are shared on the basis of the partner's capital contribution. That's not the same rule as with general partnerships. But when you're talking about limited partnerships, the idea is that the partners are really basically investors. So if you have a profit from the company, then you have to look at how much each person contributed for them to determine how much of the profits they have a right to share. The right to information is very similar to the one that we discussed with regard to general partnerships. Really, it's the same rule, but it doesn't hurt to go over. Upon a reasonable demand for information, the limited partnership has to give the information to the demanding partner. They also have to keep the records. If they don't keep the records, then they will be in violation of the duty of care, which, as we discussed before, is owed by the partners to each other. This includes, again, this is the information that people are entitled to by virtue of their being partners: copies of the certificate and all amendments to the certificate, any changes to the certificate, names of the partners, agreements, copies of the tax returns, copies of the financial statements. These are things that partners, whether they're general partners or limited partners, are inherently entitled to. Can you add partners? The answer, of course, is yes, if you have the consent of all the partners, or unless the agreement specifies otherwise. The default rule under the revised Uniform Limited Partnership Act is that all the partners have to agree before you add another partner to the partnership. On the other hand, if the original agreement said that we can add partners by majority vote or by 2/3 vote or by whatever vote is specified, then that controls. In other words, the agreement can change the default rules to whatever extent the partners agree. So new partners can be admitted, but under the terms specified in the agreement. But if the agreement doesn't specify anything one way or the other, well, then you need all the partners to agree in order to add a new partner. Usually this new partner will be an investor. The new partner will probably be a limited partner, where the new partner will give certain capital contributions to the company in exchange for an ownership share of the business. Okay, next we're going to move on to a couple of other issues that are relevant to limited partnerships. Now, the truth is that a lot of these issues are relevant to all types of partnerships, but we're discussing it in this chapter. First of all, the issue is something considered foreign or domestic? Now, you may say, well, who cares whether it's foreign or domestic? And the answer is that foreign companies have certain tax requirements and certain reporting requirements and all that, so very often it is important to make a determination as to whether an entity is foreign or considered domestic, which means, of course, subject to the laws of the United States. Well, even foreign companies sometimes are subject to the laws of the United States, but where is the central location of the company considered? And in this context, we're talking about both inside the United States versus outside the United States, and also within various states. A limited partnership that's filed in New York, for example, would be considered for this purpose a foreign limited partnership in the state of New Jersey. So we're talking about both within the United States versus outside the United States, and states compared to other states. And under the Uniform Limited Partnership, there is a very simple, very logical rule. The laws of the state in which your entity is organized governs its organization. So if you file in Delaware, your limited partnership is subject to Delaware laws, even though you may never have been to Delaware. Many people do file in Delaware because Delaware has got favorable rules regarding corporations and regarding limited partnerships and LLCs. The fees structure is a little bit different, so many people file in Delaware, and therefore their companies are subject to the rules of Delaware, even though the business may have nothing to do with Delaware. And the certificate of registration would be the thing that's filed in Delaware that makes it subject to Delaware rules, and that makes it a Delaware partnership, for example. As we discussed before, the key distinction between a general partnership and a limited partnership is based on the idea of liability. The general partners, even in a limited partnership, have unlimited liability. These are the people who are comparable to the partners in a general partnership. These are the people who run the company, and they have got unlimited liability, which means they are personally liable if the company gets sued, if the company commits a tort, or if the company gets subject to some sort of a judgment. The limited partners are only liable up to the amount of their contributions. That is the maximum that they can lose, but by the same token, they give up their right to control and manage the company. Only the general partners have the right to share in the management and voting rights in terms of how the company is managed. What can a limited partnership? What can a limited partner do and not lose his or her limited liability? Now, if you have a limited partner and it turns out that that limited partner is running the show and that limited partner is really acting as a general partner, then a court might say this person really is a general partner and lose his or her limited liability. However, you can have at least some element of management of a limited partnership and still be considered a limited partner. In other words, what can you do? You can be an agent of the limited partnership. If you're a limited partner and the general partners appoint you as an agent to do something for the company, that's okay. You can still be a limited partner. You can also be an employee. You can also be a contractor for the limited partnership. And of course, you can be a general partner, but then if you're a general partner, obviously you lose your limited liability. I'm going to write that over here, but then you lose the idea of limited liability, because then you're a general partner and not a limited partner. And of course, you can also be a consultant or advisor. Just because you're hired by the general partners, you just can't have a voting right. In other words, you just can't be the person that actually is fundamentally in charge of managing the company. If the people that do manage the company, in other words, the general partners, appoint you as an employee or as an agent, that's fine. You can act as a surety, in other words, as a guarantor for loans that are taken out by the company. You can approve or disapprove an amendment to the partnership agreement. That's not really considered management of the company. And voting on certain specific partnership matters. Really, what you can't do is be somebody who is in charge of the day-to-day operations of the company and is the person that has the final say on these matters. And what this means, what the result of this is that limited partners, of course the general rule, are not individually liable for any debts that are owed or torts that are committed by the partnership. There are some exceptions. If the formation was defective, in other words, the proper documents weren't filed, well, then everybody has unlimited liability because now it is not a valid limited partnership. If you participate in the management, you can then lose your status, as we discussed before, as a limited partner. And also, even if you are a limited partner, if you make a personal guarantee on a loan taken out by the partnership, let's say, well, then you'll be personally liable. Just like if you weren't a partner and you made a personal guarantee, you would be liable for the repayment of that amount. Dissolution of a limited partnership is somewhat similar to a general partnership, which we covered before. It could be at the end of the life of the limited partnership if the time span is specified in the certificate. A partnership can be dissolved with the written consent of all general and limited partners because of the withdrawal of a general partner. Remember, with a general partnership, any partner that withdrew dissolved the entire thing. A limited partnership, on the other hand, it has to be a general partner that's withdrawing. If it's a limited partner, in other words, an investor that's withdrawing, that does not automatically cause the entire partnership to dissolve. And finally, if there is a decree of judicial dissolution, in other words, if a judge orders it to be dissolved for whatever reason, either because one of the partners brought an action or for some other reason, a judge can order the partnership dissolved. When you wind up a limited partnership, the default rules are pretty similar to what we discussed before regarding a general partnership. You have to wind up upon dissolution, file a certificate of cancellation with the Secretary of State. In other words, when you established the partnership originally, you had to file a certificate with the state to establish that you had a limited partnership, maybe pay a fee. So the same thing is true. When it ends, you have to file a certificate of cancellation. A general partnership doesn't have to do this because a general partnership doesn't have to file a certificate in the first place, but a limited partnership does. And as far as distributing the assets, these after these, well, if there are assets, then they have to be distributed. And the Revised Uniform Limited Partnership Act provides this preference order. First, you have the creditors, then the partners with respect to unpaid distributions. In other words, if there was supposed to be a distribution and one partner never got his or her distribution, that becomes the first thing paid out, then capital contributions, then the remainder of the proceeds. Essentially, these are the same rules as we discussed when we discussed the general partnerships. Our next business form is the limited liability company, or more simply known as the LLC. The LLC is designed to be a hybrid between the corporation and a partnership. Really what an LLC, in a little bit more detailed explanation, is really supposed to improve on the limited partnership. As you recall, the limited partnership has some limited partners and some general partners. The limited partners have limited liability, the general partners have unlimited liability, and that was designed to take advantage of the limited liability feature of the general corporation and the simplicity feature, or the taxation benefits, of the partnership. And so at some point, somebody woke up in one state, I don't know which state started it, probably Delaware, one of those, and woke up and said, I have an idea. Why don't we do something that is similar to a limited partnership, except nobody has unlimited liability. Everybody has limited liability. In other words, we'll make the whole thing just like a corporation when it comes to liability, but just like a partnership when it comes to taxation and the other aspects. And so they formed and the LLC was born. So the LLC, in terms of its formation, very similar to a limited partnership, but it has that one big advantage that nobody has to be a general partner. There's a managing member of an LLC, but the managing member's liability is limited as well. In other words, even the managing members are not personally liable for debts of the LLC. So forming an LLC is very similar to forming a limited partnership. You file articles of incorporation or articles of organization, and the shareholders are called members, and then there are managing members who are the people that actually run the company. You've got limited liability for all members. You've got no double taxation. You've got easy transferability of shares. In other words, you can transfer interest. Just like a corporation, you can sell parts of an LLC. You can give shares of an LLC. You can transfer shares of an LLC. In that way, it's a lot better than a partnership. Remember, in a partnership, when a general partner or any partner in a general partnership leaves, then the whole thing automatically becomes dissolved. That is not true with an LLC. With an LLC, you can transfer shares, you can transfer ownership interests, you can transfer interests in the LLC, and the thing does not get dissolved. So therefore, you've got good capitalization potential, no cap on the number of members. We'll see in the S corporation is a different type of corporation, has a limited number of members. LLC has no limit on the number of members. You can sell shares, you can buy shares, you can get investors. And in terms of the control of the LLC, the members don't inherently get rights to vote. That was one of the problems with the partnership, that everybody has an equal stake in the management. Well, that's not necessarily true with an LLC. With an LLC, you can have a managing member, and the managing member is the person that actually runs the show. See, the LLC, as you can see, is really a very good business form. It's better than, it has a lot of features that are a lot better than all the others that we've discussed so far. And in fact, it's probably the single most common business form of new businesses when they start, assuming they're not a sole proprietorship. In other words, if you're going to go actually and form one and go to the state and pay the fee and file, you're probably going to end up forming an LLC. There are still limited partnerships around, there are still corporations around, but the LLC, generally speaking, is a very strong form of business and a very popular form of business. And another great thing about the LLC, interestingly enough, is that as you can see over here, an LLC can elect to be taxed as a partnership, but it doesn't even necessarily have to do that. The IRS, and as far as the tax code goes, there's really no such thing as an LLC, because an LLC is something that is created by state law. The IRS doesn't even really recognize an LLC, because an LLC can choose to be taxed as a corporation or to be taxed as a partnership. So as an LLC, you can actually choose from year to year based on which is a better idea for your particular company at that particular time. Usually, LLCs will choose to be taxed as a partnership, but if for whatever reason they want to be treated as a corporation for tax purposes, they can choose to do that as well. The owners can manage the business, and of course all owners, even the managing members, have limited liability. These are created by state law. I mean, really, all of the business forms we've discussed are a matter of state law. If you want to form a corporation or you want to form a limited partnership, you have to file something with your Secretary of State, not with the federal government. But as I mentioned before, the corporation has special rules with regard to federal taxation, for example. They have to file their own Form 1120, which is a corporate tax return. A partnership has to file a Form 1065. An LLC can kind of choose because the federal law doesn't even really make a provision for an LLC, although it does specifically allow LLCs to choose whether they want to be taxed as a corporation or to be taxed as a partnership. And just like you have the Uniform Partnership Act and the Uniform Limited Partnership Act that usually defines how partnerships are run and what their default rules are, you've got limited liability company codes. The Limited Liability Company Act and the Revised Uniform Limited Liability Company Act, etc., that determine how LLCs are run. The LLC is a separate legal entity. In that way, it's a lot like a corporation. An LLC can own property, an LLC can sue and be sued, can enter into contracts, and can even be found guilty or civilly liable, and can be punished, can be fined, can even be shut down by the government. In this way, an LLC is very much like a corporation. A corporation has a status of a separate legal person, and the LLC also has a status of a separate legal person. And the LLC, assuming the articles of organization don't specify otherwise, is governed by the uniform rules that are covered by the Uniform Limited Liability Company Act, or the ULLCA, which of course is the LLC's version of the Uniform Partnership Acts, or the Uniform Limited Partnership Acts that we discussed a little bit earlier. Now, all of these rules are only applicable if they are adopted by the states. Basically, what a uniform rule is, I didn't mention this earlier, but really what a uniform rule is, it's a series of rules that are written by experts in the field, not by any particular government employee, but by experts in the field. And then the states, if they want to, can adopt these rules as their own state's rules. Now, some of these have been adopted, some of these uniform rules have been adopted by every state, like the Uniform Commercial Code. Then there are some that have been adopted by some states and not others, like the Uniform Probate Code. There are some uniform rules that haven't been adopted by any states, like the Model Penal Code. But I'm not going to worry about that too much right now. That's not really the key thing. The key thing is that the ULLC, if there are rules that govern a particular case, they're not necessarily binding on a particular state or on a particular LLC unless that particular state has adopted the ULLC as its own state's rules. And again, just like a corporation, an LLC has powers to do things like an independent legal person. It can own, mortgage, or transfer property. It can do the same for personal property, real property and personal property. It can enter into contracts. It can make guarantees. It can borrow money. It can issue notes, issue bonds like corporations can. It can borrow money and borrow money from shareholders. And, of course, can sue and be sued. It is an independent legal person just like a corporation. And the members have limited liability. The limited liability applies to members of the LLC, and that means that members of the LLC are only liable to the extent of their capital contributions, which means you can lose what you invested, but you cannot lose more than that. Of course, one little caveat to that, and this is always true, whether you're talking about a corporation or an LLC or a limited partnership, if the person actually commits the tort. In other words, if I own the LLC, and I'm running a restaurant and I negligently, give somebody food poisoning, well, I can be sued personally, even though it's an LLC. That doesn't protect me if I personally committed a tort. If I personally damaged somebody, I can still be liable. But the point is that a debt strictly of the company does not transfer as my own personal debt. And this is a chart that kind of illustrates this concept of liability. And that is, you have the members who invest in the LLC, and the LLC can owe money to the third party. So the third party can collect money from the limited liability company, can sue the LLC and collect whatever money is in there, but cannot directly get money from the members. So that's why the investment is limited to a capital contribution and there's no personal liability. I think we've covered this concept in many different ways so far in this course. And just like any other business, the LLC is liable for loss or injury caused by an action of a member, manager, employee, or agent in the ordinary course of business. This is really a tort rule, and the rule is something called respondeat superior, which means the boss, literally it means the boss has to respond, or the boss has to answer. So if you have a business and somebody who is representing the business, somebody who works for the business, signs a contract with a vendor, or commits a tort in the ordinary course of business, then the company is going to be liable, just like any other business. Okay, as far as the LLC goes, in terms of how it's formed initially, well, we've got the formation of an LLC, and the formation of an LLC is simply, is similar to the formation of a limited partnership. An LLC can be organized to operate businesses, real estate developments, etc. Certain professional groups may have to form their own special type of LLC. Some states have a PLLC, which is a professional LLC. Things like law firms and doctors' offices, dentists' offices, other professional offices may have their own special type of company that they have to organize, but virtually all businesses can establish and run as an LLC. An LLC can be organized in only one state, even though it can conduct business in all other states. You can go form a Delaware LLC, and it may go and then do business in multiple states that are separate. Again, that's true with corporations in general. The way the LLC forms is by establishing or by filing, by drawing up and filing in articles of organization. The LLC is formed by delivering the articles of organization, which is a series of initial rules that set up the LLC, to the Secretary of State for filing, and that has to include certain very basic information. This is very similar to the Articles of Incorporation for a corporation. It has to include basic things like the name, the address of the office, name and address of the agents and organizers, the type of LLC being formed. It also specifies what it's organized for, but it can be very vague. For example, it can specify that it's being established in order to do any lawful business or to make money or something like that. So it can be very vague, and very often it is very vague. A duration in LLC could be perpetual, or it could be limited to a specific period of time. Most LLCs that are formed are simply perpetual, which means they exist until they're dissolved. A capital contribution to an LLC is very similar to a capital contribution to a partnership. Anything can be contributed to an LLC, which again includes services, includes promissory notes, other agreements, money, tangible, intangible, and not excused by death or disability, which means that just like when you're talking about a partnership, this becomes something that is owed to the partners, or to the LLC members. If the LLC member dies, well then, as we'll see a little bit later on, there's no right of survivorship necessarily when you're talking about an LLC, because when an LLC member dies, his or her shares are like shares of a corporation. It goes to the person's family. It goes under the person's will. Just like if a person dies and owns stock in Google, that Google wouldn't go to the other shareholders of Google. That stock in Google would go to the person's heirs. Well, the same thing is true when you're talking about an LLC. You may have noticed so far there's a kind of a theme going on here, and that is an LLC is very similar to a corporation. The only major difference between a corporation and an LLC being the issue of taxation. Whereas a corporation pays its own income tax, the LLC taxation is, if it elects to be treated as a partnership, is taxed directly to the partners. An LLC gives out certificate of interests, which are certificates that illustrate how much stock or how much ownership interest each person has, similar to a stock certificate when you're talking about a corporation. Today's day and age, you might not have paper certificates. They could be done electronically, or they could be just done in the books. But in other words, you have the same structure. Just like instead of stock, they call it interest. Instead of stockholder or shareholder, you're called a member. But it's the same basic idea. And an LLC can have an operating agreement. An operating agreement is an agreement among the members that governs the affairs and business of the LLC and the relationship among the members and managers of the LLC. And it can be amended, which means to be changed by the members, either by a majority vote or by unanimous vote, again depending on what the original document said. Just like corporations have bylaws, an LLC can have an operating agreement, which specifies virtually everything about how the business is going to be run, and how this document itself can be amended later on, if at all. According to the Uniform Limited Liability Company Act, each member has the right to an equal share of profits and losses. That's the default rule when we were talking about partnerships, and that's the default rule when we're talking about LLCs. Of course, if there is an operating agreement, the operating agreement can specify something else. Then you have the distributional interest. The distributional interest requires the members to receive distributions of money and property from the LLC. This is like having stock. This is like having the ability to get profits from the LLC. By having a distributional interest, you have the right to be distributed, along with the other members, your share of the profits. Now, an LLC can be member managed, or it can be manager managed. It can be member managed, which means in a member managed LLC, all members of the LLC can bind the company by agreeing to contracts with outside vendors or outside parties. And in such a case, each member would have equal rights to membership, regardless of their capital contribution, and any matter would be set to a majority vote. That's one possibility. And again, how is this determined? This is determined by the operating agreement. Otherwise, the operating agreement can specify that a manager is only a manager or only a group of managers are entitled to bind the LLC, are entitled to do business on behalf of the LLC. That those people would be called the managing members. Almost always those are people that are actually members, and they're chosen from among the members to manage the LLC. So the members and non-members who are designated managers control the management. They don't have to be members. For example, if you want to hire an outside manager, like a chairman of the board when you're talking about a corporation, that person doesn't have to be a member. Usually the manager is a member, but if you want to hire a financial professional to run the LLC who's not a member but gets a yearly salary instead or something, that's perfectly fine. Again, whatever the operating agreement says will control. In this case, the members who are not managers have no rights to manage the LLC unless otherwise provided in the operating agreement. Of course, a non-manager member is not entitled to compensation. When the LLC is being winding down or winded up, they're entitled to get their share of the ownership interest, but they're not entitled to, let's say, a salary. On the other hand, people who are managers of the LLC, unless specified otherwise in the operating agreement, are entitled to be paid compensation and whatever other normal benefits there are when you're talking about managing an LLC. Again, these things really should be specified in the agreement itself in terms of what the salary is, or it can specify that they'll pay a reasonable salary. And of course, you can hire managing members. You can negotiate with managing members, just like you can negotiate with people who run a business. You can negotiate with managing members to make a determination of their salary. An LLC is obligated to reimburse members for payments made on behalf of the LLC. Again, that's, fairly common sense. Now, who can bind the LLC? In other words, which member of the LLC can sign a contract on behalf of the LLC, and the LLC has to listen? Is it any member, or is it just a manager? Well, here are the rules again, fairly intuitive. Any member if it's a member-managed LLC. Remember, in the member-managed LLC, everybody had voting authority. Every member had the ability to manage, or the right to vote and the right to manage the LLC. Well, in such an LLC, any one of them can go sign a contract with a third party, with a vendor, and the LLC is bound by it. When you're talking about a manager-managed LLC, where you only have some members are managing members, well, then it's only them that have the authority to actually sign a contract on behalf of the LLC, and then if they do, of course, the LLC is liable. LLC managers have the similar fiduciary responsibilities as we discussed when we were talking about partnerships. There's the duty of loyalty. And again, the duty of loyalty, this is going to be a little bit of a review. The duty owed by a member of a member-managed LLC or a manager of a manager-managed LLC. Basically, if you are a manager, then you have a fiduciary responsibility to the company. You have to be honest in dealings with the LLC. Don't act adversely to the interests of the LLC. You can't usurp a corporate opportunity, usurp an opportunity, make secret profits, secretly dealing, secretly competing, representing any interest adverse to the LLC. All the same rules as we discussed before when we were talking about a partnership. And there's also a duty of care. A duty of care means that if you are handling LLC assets or LLC business, you are not allowed to engage in conduct that negligently puts the interests of the other members at risk, such as by knowingly violating the law, intentional conduct that could cause damage to the company, reckless conduct, or even negligent conduct. And so ordinary negligence or negligence that causes the LLC to suffer some sort of a debt or to suffer or to be sued. Let's say, for example, I'm managing an LLC that owns a restaurant and I negligently leave the food out and somebody gets food poisoning because of that. Well, then that person can sue the LLC under the doctrine of respondeat superior that we discussed before, and the LLC can then turn around and sue me for a violation of the duty of care because I messed up with the company business. I negligently messed up with the company business and therefore caused them to be liable. There is no fiduciary duty, as we discussed before, owned by a non-manager member, because the non-manager member doesn't have any role in the managing or the running of the company anyway. So that person doesn't have any duty of loyalty. If I only own a share, if I'm only an investor, let's say, so I own a share of an LLC, but I don't manage it, and I want to open up a competing business, or I want to, do business with the LLC, that's fine. I can do both of those things, and the reason is because I don't owe a fiduciary responsibility to the company. As far as an LLC goes, again, it can expire only by dissolution if its time runs out or something to that effect, not by simply one member leaving. If an LLC is about to expire, members can vote to continue the LLC, or it can be continued as a quote-unquote at-will LLC. At-will LLC means perpetual, means it can be continued after its term expires if there is a vote for it. When you're talking about winding up an LLC's business at the end, well, the process of preserving and selling an LLC and distributing the property and to creditors and members is the winding up process, and the same basic rules apply here again as we discussed when we were talking about a partnership. Creditors are paid first, and then including capital contributions, and then after all of that, surplus amounts are distributed to the members in equal amounts. That is the default rule. If the operating agreement changes that, then of course whatever that says controls. And just like when we were talking about the limited partnership, to end an LLC, you do need to file articles of termination, which end the LLC's business with the same organization, same Department of State that you used when you filed the original articles of organization. Our next form of business is the corporation. And we're going to start with the corporation with a discussion of how you actually form a corporation, or the discussion of corporate formation. Well, a corporation in general, similar to the LLC that we just discussed, is a fictitious legal entity that's created according to statutory requirements. In other words, it's created under state law, and the state law will really determine how it's governed and what the requirements are. Now, there are two basic types of corporation. There's the open corporation and the closed corporation, or the closed corporation. Now, the open corporation is something that is available on the open market. Something like Microsoft or Google, something that can be traded on the stock market, is an open corporation, whereas most corporations, when they are originally formed, or certainly many mature corporations to this day that are not traded on the open market, are called closed corporations, or closed corporations, where the shares are not accessible directly. If I want to buy somebody else's corporation, I can't automatically buy it, whereas if I want to buy a share of Google, all I have to do is go onto my brokerage account and do it that way. So a closed corporation, or a closed corporation, is controlled only by a few people. Now, the advantage, of course, of a closed corporation is that it's easier to make decisions. You don't have to go to the public, you don't have to have these massive elections and massive meetings of the public to make a determination as to whether something can be done. There's also limited accountability to shareholders. You don't have to worry about the shareholders because usually the people who are running the company are the shareholders. For a closed corporation, you're usually talking about a family business or a relatively small business. You don't have to worry about appeasing the market or appeasing the public because there is no market and there is no public. And they're not as heavily regulated. The SEC, for example, doesn't really apply to, the SEC regulations don't really apply to closed corporations. They generally only apply to publicly traded corporations. So why do people have open corporations? Well, there are two real reasons. Number one, it makes it much easier to raise money, and number two, it's easier to resell the shares. Both of them are really the same idea. If you're Facebook and they were already worth a couple of $1 billion before they even hit the open market, but the ability to allow the public to buy shares
it makes it a lot easier to raise money. And Facebook went from a company worth a couple of $1 billion to a company worth tens of billions of dollars. And that's what happens with many of these companies. Companies are doing well, but then they go out on the open market and allow anybody to buy their shares at any time, and then all of a sudden their valuation increases by 10 times, or their valuation increases dramatically. They do an IPO, and again, people do it even though there are handicaps in terms of control and in terms of regulation, because of the fact that you can make so much more money when you're talking about an open corporation that is traded on a public exchange. Okay, how do you actually form a corporation? Now, a corporation is a creature of state law, which means that it's created under the rules of whatever state you happen to be in. So it's not really a federal issue necessarily. There are some federal legislation, there are some federal rules that govern corporations, there are securities rules, there are general business rules that apply, but when you're talking about forming a corporation, originally you're really talking about an issue of state law. And the formation of a corporation requires three steps: people, paper, and acts. I'm sorry, the acts is kind of cut off at the bottom of the slide over there, but we're going to discuss each in turn. First of all, let's discuss the people that are necessary to form a corporation. Well, there has to be, to start with, an incorporator. An incorporator is somebody who goes to the state and says, I would like to form this corporation. It doesn't necessarily even need to be a shareholder, it doesn't necessarily need to be anybody that's involved in the company, but the incorporator needs to be the person who's actually going to the state and filing it. Very often that could be an attorney or a paralegal who works for the firm, or a secretary who works for the firm that's helping the business, or it could be the principal, him or herself, or it can be an agent. You can go online and go to, incorporator websites or incorporator services, and they'll form a corporation for you. They know what to do, they know where to mail it, they know how to do a name search, they know how to do whatever it needs to be done to form a corporation, and that person can be the incorporator. There's really no specific rule about who can be the incorporator, except they have to be 18 years old. It's not clear whether another entity can be an incorporator, but it's really easy to do because pretty much anybody can be an incorporator, so this is not usually a major problem for anybody. Then there are the people who run the company and own the company. The people who own the company are called the shareholders. The people who manage the company, the people who run the company, are called the directors. They are the people that have the ultimate say as to what happens. And then you have the officers. The officers, like the president and the CEO, are people that run the day to day operations of the company. Of course, one person or one group of people can play multiple roles. The president can also be a shareholder. The president can also be a director. A director can also be a shareholder. If there's a single person that owns a whole corporation, well, then that person is the sole shareholder, the sole director, and the sole officer. There's nothing inherently wrong with people taking two or more of these roles, but these are the three basic roles when it comes to owning and managing a corporation. Next, we have the paper elements, and the paper elements are the filing of the articles of incorporation, similar to the articles of an organization for an LLC, and the articles are a contract between the shareholder, the incorporators, and the state. The articles of incorporation are a relatively simple document, usually only a couple of pages long, and it contains certain basic information about what's being filed. This you're going to file with the state, and so it only needs to contain some very basic information. The company's name and address, the name and address of the incorporators, could be one incorporator, could be multiple incorporator, the purposes of the corporation. Now, this can be very broad. As we discussed before, very often they'll say something like, the purpose of the corporation is to engage in any lawful business. Authorized stock issuance. If the corporation is being authorized to issue stock initially, the articles of incorporation will say so. Now, this can be changed later on, just because you don't issue stock originally. Issues stock meaning shares of ownership of the corporation to new people. Stock is like a percentage. If there are 100 shares of the company, well, then each share represents 1% of the entire ownership of the corporation. Duration of the corporation's existence doesn't have to be there. If it doesn't, then the assumption is that it goes on perpetually or until it's dissolved, really forever. And some states require corporations to designate an agent for service of process. For example, if you're going to be sued, well, where can they send the lawsuits? Very often you will have to name the Secretary of State of that state as the agent for service of process. So if I want to sue a company, I don't actually have to go down and track down the company itself. I can simply mail the lawsuit or serve the lawsuit on the Secretary of State's office. So that is the paper requirements. There's also the corporate bylaws. Now, corporate bylaws are not necessarily required, but corporations do have them at some point. They don't have to be originally, they don't have to be set up at the time of the Articles of Incorporation, but they're set up later on. Usually they're adopted by the Board of Directors after the articles are filed. And the corporate bylaws are kind of like a constitution under which the corporation operates. There are templates that people can use and just kind of use generic corporate bylaws, but they can also be modified. They can say things like, when is the annual meeting? What kind of corporation can the business do? What kind of votes are required? Who can serve as officers? Who can serve as directors? How do you transfer shares? Are there restrictions on share transfers? These are all things that will be taken care of by the corporate bylaws, which are usually much more complex and much longer than something like a corporate in Articles of Incorporation, which is filed originally. The corporation must also issue stock certificates where they want to give out stock, and there's also requirements sometimes that an out-of-state company register before doing business in a state. If I'm registered in Delaware and I want to do business in New Jersey, I might have to go to the New Jersey Secretary of State and register. The reason why states make you do that is again for this designation of a service of process representative. They don't if somebody wants to sue you, they want the Secretary of State to be able to receive process. And finally, you've got the acts. These are things that have to be done in order for the corporation to start operating. You need the signatures of all the incorporators, you need filing. You need to go to the state and file the articles of incorporation, pay a whatever fee there is, and then the incorporators or the shareholders, usually it's the same people, meet and elect an initial board of directors and adopt initial bylaws. The voting at the very beginning, the voting is really based on the shareholders. So if there's only one shareholder, that person makes all the decisions. If there are three shareholders, well then they have a vote on things like electing a board of directors. Once they elect the board of directors is really going to manage the company. Okay, so now let's look over some of the other aspects of a corporation, and a lot of these things we've already covered, but these are all important aspects of a corporation. Corporation is a legal person, which means a corporation is a separate legal entity, is really distinct from its shareholders and distinct from its directors. A corporation can sue or be sued, can enter into and enforce contracts, can sue to enforce contracts, and can be sued to enforce contracts against them, hold title to and transfer property. Real estate can be in the name of a person, real estate can be in the name of a company. And it can even be found civilly and criminally liable, can even be prosecuted. A corporation also has certain characteristics. It has limited liability of shareholders. That's really the key to the corporation. In other words, the shareholders are not liable personally just because they're shareholders if a corporation has a debt. Really, if you invest in a company, you invest in a corporation, the most you can lose is the amount you put in. You can transfer shares freely unless specified otherwise in the corporate bylaws. They can exist forever, and they have centralized management, which means there are a group of people, namely the directors, who are elected by the shareholders, and they have control over the company. Limited liability, as we discussed before, that shareholders are only liable to the extent of their capital contributions, to the extent of their investments. They're not liable for debts of the company beyond what their investment is. The worst they can do is lose what they put in and are not personally liable for debts of the company. Now, if transferability means that corporate shares can be transferred by a shareholder. One shareholder can sell or give away the shares that he or she owns. Shareholders, of course, also may agree amongst themselves regarding limitations on this kind of transferability. But free transferability without these kinds of limitations is kind of a hallmark of the default rule for a corporation. And a corporation can last forever. It can be voluntarily terminated by the shareholders, or it can be involuntarily terminated by the creditors. If the corporation owes money and is not paying, a corporation can be liquidated by a court upon lawsuit by the creditors so that its assets can be divided up among the creditors to pay their debt. Centralized management means the board of directors makes the policy decisions. Now, there are actually some decisions that are made by the shareholders, mainly whether to dissolve, which directors to elect, whether to merge with another company in some cases, but most decisions are really the directors are the ones who are in charge, although the board of directors themselves are elected by the shareholders. And again, here you're talking about state law that will govern these default rules because there's no general federal corporate law except to the extent of securities and other federal regulations that govern the marketplace. There can be corporations that are for profit, and there can be corporations that are non for profit. For profit corporation is most corporations a company that can conduct business for a profit and distributes profits in the form of dividends. That's how shareholders get their money, get their profits from a corporation. If a corporation makes money, well, then they can turn around and take that money and distribute it to the shareholders. Of course, the shareholders and the directors may be the same people, and so they make the determination to give it to themselves, and that's fine. Obviously, there are tax implications of that we'll discuss a little bit later on, but the general rule is that corporations, if a corporation makes profits, that profit can, but doesn't necessarily have to, be distributed to the shareholders. The difference between that and a nonprofit corporation is a nonprofit corporation can't give out dividends. A nonprofit corporation is not supposed to make a profit. Now, it may make a profit 1 year because it does business, but then that money has to be kept in the company and used towards the other company's goals. The reason why you want to make a nonprofit corporation is because a nonprofit corporation can be eligible for tax exempt status. Could be a charitable corporation, could be a religious corporation, could be a school that's owned by a nonprofit corporation. These things may be eligible for tax exempt status, assuming they meet the other requirements of the Internal Revenue Code, but it has to be nonprofit. A for profit corporation can never get tax exempt status. And of course, there are also some other state and federal rules that make it a little bit more favorable to be a nonprofit. But again, the trade off is that you're not going to be able to get a dividend. If the company does make a profit for whatever reason, then it has to keep that within the organization. Then you've got, as we discussed before, the distinction between a publicly held and a closely held company. A publicly held corporation has many shareholders and the shares are available on the open market. This is sometimes called a security. Securities and Exchanges Commission regulates it. And then you've got closely held companies where you have only owned by a few shareholders and shares are not traded on the open market. Now, the next question is okay, where do you go to incorporate? You can only incorporate in one state. Now, it doesn't mean that you can only do business in one state. There are certainly many big corporations that do business in all 50 states, but you can only incorporate initially in one state. Very often, people do this in order to minimize the fees that they pay, or in order to have more friendly corporate laws. Delaware, for example, is a very common incorporation state, and the reason is Delaware charges less fees in terms of incorporating, and it also has some rules that are favorable to corporations that some other states might not have. So a corporation can be domestic in the state in which it's incorporated. It could be foreign, which means it's from another state, or it could be alien, which means it's incorporated in some other country. All of these are legitimate. All of these can do business in the United States. There may be certain restrictions or certain limitations or certain differentiations based on taxes and based on fees, based on certain other things. But it's important to know that if you form a corporation in Delaware and then do all your business in Michigan, well, then you're going to be a foreign corporation in Michigan. Not necessarily a terrible thing, but it is something that you need to be aware of. A promoter is somebody who's not the incorporator or necessarily even a shareholder of a company. A promoter of a corporation is somebody who organizes the start of the corporation and negotiates to enter into the contracts that the corporation will need to do business. Now, of course, the promoter could be a future shareholder of a company, and very often is, but a promoter essentially is somebody who acts before the corporation exists on its behalf. Sometimes the promoter will find the initial investors of the company. Now, really, the question is, are the promoters liable for the debts of the company that will arise? Because the whole idea of the promoter is to organize contracts on behalf of the company, but when the company actually starts doing business and starts to exist, the theory is that the company would take over its own debts and the promoter would no longer be liable. However, the promoter does retain certain liability. Again, here, for example, we're talking about a case where a promoter might know that later on the promoter and a few friends are starting a restaurant, and so therefore the promoter goes and organizes agreement saying, we're forming ABC Corp to establish a restaurant, and we'd like to order 1,000 pounds of meat to be delivered, scattered over the course of the next 3 months at these intervals, and this is the amount we'll pay, etc. And the person might organize the a deal on behalf of the future company. So if the corporation never comes into existence, there's some sort of a problem and it never starts, well then of course the promoters have liability on the contract. If they make an agreement and they actually sign an agreement on behalf of this company with the supplier, and the supplier, obviously needs to get paid, so if the company never exists, the only person that's really left to be liable is the promoter or the promoters. If the company does come into existence, well, then the understanding, assuming the vendor, the other party, knew that it was just being entered into on behalf of a company, the understanding is that it will be the company that will retain the ultimate liability. And therefore, the promoter is no longer personally liable unless the contract itself said that the promoter retains liability. So if Joe negotiates a contract with the vendor on behalf of ABC Corp before it's even formed, and then ABC Corp is being formed, the assumption is that ABC Corp will be liable and not Joe personally. On the other hand, if the contract with the supplier says that Joe has to retain personal liability, maybe that's the only way the other party would sign, as if Joe guaranteed personal liability, or for whatever reason, if Joe agreed to remain personally liable, then of course Joe does remain personally liable. The promoter remains liable in the contract unless the parties, again, in the second case, if the promoter agreed to remain liable, well, then the promoter does remain personally liable, even aside from the liability of the corporation, unless the parties enter into a novation. A novation essentially is an agreement between parties that changes the parties to a contract. So if they later on agree that instead of Joe being liable, ABC Corp will be liable, then that's binding. Otherwise, if Joe agreed to be liable, well, then Joe retains liability. All pretty self-explanatory and fairly intuitive. The Articles of Incorporation, as we discussed before, are the basic governing documents of a corporation. They have to be filed with the Secretary of State and contain basic information. Okay, what happens if you need to change the Articles of Incorporation? Well, then you can establish an amendment. You can amend the Articles of Incorporation to include pretty much any change. It has to show that the board of directors adopted a resolution recommending an amendment, and then the shareholders are the ones that actually make this decision. If it's amended to change, for example, the number of shares that could be distributed, the purpose of the company, or pretty much anything else that's in the articles can be amended. In order to be amended, the board of directors have to recommend it, and then the shareholders have to approve it by majority vote. In terms of the status of a corporation, well, here we have reference to the RMBCA, which is the Revised Model Business Corporation Act. And that's one of these model rules similar to the Uniform Partnership Act or the Uniform Commercial Code or the Uniform Limited Liability Company Act, like we discussed before. And that provides that corporate existence begins within the articles of incorporation that are filed. That, of course, is important in terms of liability. Who is going to be liable? When can this company actually sue or be sued? When can this company enter into a contract? When can this company be liable? In other words, if the employee of the corporation commits a tort, well, then the tort could be sued, but that only applies if the company actually existed at the time the tort was committed. If the articles hadn't been filed yet, well, then the individual who committed the tort, the individual who caused the damage, could be personally sued, but the corporation can't be sued because the corporation didn't exist at the time that the tort was committed. So, the filing of the articles of incorporation is proof that the corporation exists as of the time they were filed. As of that, only the state can challenge the status of the corporation. In other words, it is presumed that this corporation now exists as a separate legal entity. The purpose of a corporation, as we discussed before, can be pretty much anything, and most articles, or many articles, of incorporation contain a general purpose clause, which says that the corporation can engage in pretty much any legal activity. A registered agent is an agent that can receive a lawsuit or can act on behalf of the company. That should be identified in the Articles of Incorporation. And as we discussed before, many states actually require that you appoint the Secretary of State of the state to be a registered agent for purposes of receiving lawsuits on behalf of the company. Corporate bylaws are established by the board of directors, and they contain the ways in which the corporation is allowed to act, essentially the series of rules upon which the corporation is governed, and the board of directors can amend the corporate bylaws. Every corporation can also have a corporate seal. A corporate seal is a design containing the name of the corporation and the date, and it can be imprinted on legal documents. Obviously the significance of a corporate seal is that that is evidence that the corporation agreed to enter into a particular agreement or execute a particular document. An organizational meeting is held by the board of directors after the certificate is filed. Then the initial board of directors, which may only be the shareholder at that point, or it could be additional directors who are named in the articles of incorporation, and they will have the initial corporate meeting, and the initial corporate meeting will adopt bylaws, elect officers, transact business, and do pretty much whatever is necessary to get this particular business off the ground. And finally, with regard to corporate formation, I want to briefly discuss this idea of the subchapter S corporation. A regular corporation, or a C corporation, when it makes income, it's taxed essentially twice. When the company makes money, when the C corporation, when a regular corporation makes money, it has to file its own Form 1120, which is a corporate tax return, and it has to pay income tax. And then when it takes its profits and distributes its profits to the shareholders as dividends, well, then the shareholder has to pay a dividend tax, which is really just a form of an income tax. If there is a small corporation that doesn't want to have double tax, federal law allows you to instead elect to be treated as what is called a subchapter S corporation. And this avoids this double taxation. So there are certain requirements of a subchapter S corporation. Only individuals can be shareholders. There cannot be more than 100 shareholders. All the shareholders have to be United States residents and not foreign citizens. So there are certain requirements to be a corporation. Essentially, if you're a really big business or if you're traded on the open market, you cannot be elect to be considered an S corporation. Microsoft can't elect to be considered an S corporation, but a smaller company that meets the requirements of the Internal Revenue Code can elect to be treated as an S corporation. The way you do it is by filing an IRS Form 2553, which is a document that says that you want to elect to be treated as an S corporation. If you do that, Well, then the corporation doesn't pay tax on the federal level. What happens is, or on the state level, really what happens is whatever money is earned by the company is automatically considered income distributed among the shareholders, and the individual shareholders pay their own income tax. Kind of like it generally happens when you're talking about a partnership or an LLC, as we discussed before. This kind of eliminates the double taxation, uh, which is a negative of a C corporation. Our next discussion involves corporate finance. Corporate finance is really just a discussion of how corporations can get money. Well, of course, it can earn money, but how can it get money to begin with? How can it get loans and get startup capital that is necessary to start doing the business for the company in the first place? Well, there are a few different methods by which companies can establish money or make money or you make money in order to be used on behalf of the company. And we'll discuss their pros and cons and why they might not be such a good idea in some cases and why they might be good ideas in other cases. First one is operating funds. In other words, just use the money it has. Whatever money the corporation has, just go ahead and use it. Well, obviously, if you can do that, that's fantastic because you don't have to actually borrow any money and you don't have to go into debt. The problem is the company has to have sufficient profits to meet operating expenses and salaries in order to grow, and you can't use that money for dividends. In other words, if all you're going to do as a business is just simply use the money that you have, well, then it's very hard to grow. It's very hard to make new plants and buy new make new investments, buy new things that can help you make more money in the long run. And also, the shareholders might get annoyed if you're making profits and not giving them the shares, not giving them the profits, because the shareholders want dividends. They want to get their share of the corporate profits. The second possibility of getting money, again here we're still talking about relatively small companies, is taking out loans from the bank. That can be a certainly an efficient way to get money to be able to get startup capital to do new investments and new procedures. The problem is, first of all, you have to have good credit to get a big loan. You may not have the kind of capital a bank, especially if you don't have the kind of history, it may not be that easy to get this kind of a loan. And second of all, too much debt on the corporate balance sheet is not a good idea. It can make investors, especially on the open market, more wary about buying shares of your company if your company has too much debt. Number three, you can issue shares of the company. In other words, you can sell equity in the company. You can sell components of the company. If you're publicly traded, it means floating shares on the open market. Even if you're a closed corporation, you can simply sell shares of the company to private individuals, either by advertising or by getting a broker or just by word of mouth. Of course, the pros of making money or raising money by distributing shares is that there's no debt. If a company sells $1 billion worth of shares in the open market, that's not a debt of the company. Of course, the downside is that it dilutes the value of the shares held by the current shareholders. If I own 50% of the company and then I sell 20% of the company, well, now I only own 30%. Again, seems pretty obvious. And if you're going to sell securities, especially if you do so on the open market, there are strict SEC regulations, Securities and Exchanges Commission regulations. Just going public, for example, just doing an IPO and putting your stock out on the open market, like the New York Stock Exchange, is probably going to cost tens of millions of dollars in legal fees and investment banking fees because it takes a tremendous amount of effort to put together all the documents that are necessary to actually be allowed to sell your shares in the open market. Another thing you can do is you can issue corporate bonds. Now, a bond is a loan that you're soliciting from an individual, and a bond, you're paying back interest. For example, you can say, I'll give you $1,000 bond, you give me $1,000, and I'll pay you 3% interest for the next 5 years, and then I'll pay you back the $1,000. Whatever, there are many different types of bonds. There are other courses that can cover exactly what bonds are and how they operate. I'm not going to get into that in too much detail right now, but it is important to mention just that corporate bonds are loans that you solicit from people out there in the market. They could be from private individuals, it could be mutual funds, it could be pretty much anybody that buys your bonds. Now, the advantage of that is, of course, you can raise a lot of money and you don't have to dilute your shares. You don't have to give people equity. You don't have to give people control of the company. However, Again, you have SEC regulations when you're floating bonds, and just like taking out a loan from a bank, it adds to the company debt. If I sell a bond, well, then I owe that person money, and that adds to the corporate debt, which could make investors a little wary of it, and of course, it also means you got to pay it back sooner or later. These two types of distribution are called equity securities, or stocks, shares, or that's what an equity security is because you're getting equity in the firm, which means a percentage of ownership. And then there is a debt security. A debt security is another word for a bond. This establishes a debtor-creditor relationship in which the corporation borrows money from the investor to whom the debt security is issued. Again, a bond is really the best example of a debt security. Equity securities can be in the form of common stock, which means common stock means regular, plain old stock, a certain percentage of the company. If there are a million shares outstanding and I own 1,000 shares, that means I own 1/1000th of the company. There are no preferences with regard to common stock. In other words, if there are dividends or if the company dissolves or whatever it is, I get treated in the same way as other common stockholders. If there's not enough money to pay everybody, well, then everybody gets paid proportionally based on what the company has. Corporations may issue different classes of common stock. There could be preferred stock. There could be stock, for example, that gets dividends first. There could be stock that gets dissolution money first. And of course, common shareholders have limited liability. If I own a share of Google, that doesn't mean that somebody can sue me personally if there was a problem with something that Google did. Then there's preferred stock. Preferred stock, as we discussed before, is a type of equity security that is given certain preferences. They can be based on classes, classes of shares that are being distributed, different series of shares. Series A has these rules and Series B have these rules, and preferred shareholders, just like all other shareholders, also have limited liability. Here are some examples of things that can define stock. It can be a right to get a a defined preferred stock, excuse me, right to get dividends ahead of other types of shares, right if the company liquidates, in other words, goes out of business, a right to get the money before other classes, maybe a cumulative dividend right, in other words, the right to get a certain percentage, a certain amount of dividends before anybody else gets dividends, the right to convert to different types of shares, if you have maybe the right to convert maybe and buy more shares for a certain price, and the right to participate in the profits. These are just some examples of some of the things that can characterize preferred stock as opposed to common stock. There are different types of debt securities. Debt securities meaning loans that the company takes from the investor. You have the debenture and the bond, which essentially mean the same thing. It's just a question of whether it's secured or not. A debenture is unsecured, which means there's no collateral. There's nothing that can be collected, uh, can be held. If the bond isn't paid, a bond is a long-term debt security that's secured by some form of collateral. But they both mean when the investor gives the company a certain amount of money, and that entitles the investor to a certain amount of interest. A note is a debt security with maturity of 5 years or less. Again, that's just terminology. And the indenture agreement has the terms of the debt. But these are all examples of loans that companies can take out from investors. Next, let's discuss what the power of the corporation can do. And the answer basically is that a corporation can do pretty much anything that a person can do. A corporation is a legal person. And the express powers of a corporation can be found or can be implied from. I mean, this is a little bit of a misnomer. You don't really have a clause, in U.S. Constitution saying what corporations can do, but there are implication in freedoms that apply to corporations. For example, in a major U.S. Supreme Court decision a few years ago, the U.S. Supreme Court said that a corporation has freedom of speech. That was the famous Citizens United versus the Federal Election Commission ruling. And you have various state and federal rules that discuss what a corporation can do, but also it's governed by its own governing documents, including the Articles of Incorporation, its own bylaws, and resolutions that are taken by the Board of Directors. What can a corporation do? Well, again, pretty much anything. Purchase, own, lease, sell real property, make contracts or personal property, incur liabilities, issue bonds, notes, promissory notes, things like that, invest funds, sue and be sued, and in general, pretty much whatever a legal person can do. A corporation can also do things. beyond what is specifically laid out in the bylaws or in the articles of incorporation, if those are necessary to allow it to do its normal business. So, for example, a corporation, even if the bylaws don't say that the corporation is allowed to open a bank account, a corporation is inherently considered able to open a bank account because that may be necessary for it to carry out its business. Also, to reimburse its employees for expenses. These are things that, even if they're not specifically laid out in the bylaws, the implication is that corporations are allowed to do these basic things. The question really is, what happens if a corporation does something that it's not authorized to do? If the bylaws specifically say, or if the articles of incorporation specifically says that this corporation is only allowed to operate a restaurant, and instead of operating a restaurant, it goes out and operates a farm, well, that is considered an ultra vires act. An ultra vires act is something that is beyond the authority of a company to do, an act by a corporation that is beyond its express or implied powers. Remedies, there are several remedies. In other words, one of the corporate shareholders can sue. They can sue for an injunction. They can sue the officers or directors who caused the act for damages. In other words, they can, if the company lost money because of an ultra vires act, that the directors did something that was beyond the scope of the corporation's authority, and because of that the shareholders lost money, they can successfully sue for those things. And they can also bring an action to enjoin the act. Enjoin means to stop the act, to get an injunction against the act, or if it's flagrant enough, even to dissolve the corporation. Okay, so the next issue is, how does a corporation dissolve? In other words, how does a corporation actually end? It could be done by a judge. There could be administrative dissolution. We'll see what that is in a minute, or even voluntary dissolution when the company simply decides to stop operating. Voluntary is the easiest one to discuss because voluntary dissolution simply means that the shareholders vote to end the company. If the company hasn't actually commenced any business, well, then you could simply dissolve it by a majority vote of the incorporators or the board. If there already is business that has been started by the company, well, then, just like some of the other major changes that we saw before, board of directors has to recommend that the company dissolve, and a majority of the shareholders have to actually vote to dissolve the company. It's a fundamental change, and therefore it's something that the board of directors cannot do by themselves. And then you have to file articles of dissolution with the Secretary of State in order to tell the state that you're winding up the business. Then there is administrative dissolution, wherein the Secretary of State, in other words, the state, says this corporation is not following the formalities of a corporation, and therefore we no longer consider it an independent person for legal purposes. Failing to file an annual report, failing to maintain a registered agent, which many states require, as we discussed before, failing to file a change of a registered agent, not paying a fee. They're usually not going to do this right away. Usually they'll send a warning letter to the company saying, you haven't paid your fee, or you don't have a registered agent, or whatever it is, and give them some time to fix it. But in other words, if a company does not, the whole idea of establishing a corporation as an independent legal person is a privilege in terms of it's something that makes it easier to do business and makes limited liability. So based on that, the state can say, listen, if you refuse to follow the formalities, if you refuse to follow the rules regarding the operation of a company, well, then the state can say, we're not recognizing you anymore as this independent legal entity. And again, then in that case, rather than the company issuing a certificate of dissolution, the Secretary of State would do so. Then you could have judicial dissolution, where the courts can order a company shut down. Sometimes they refer to this as the corporate death penalty. It doesn't happen very often, but if the articles were fraudulent, or they exceeded their authority, in other words, some basis in a lawsuit where a court thinks that the only remedy to a particular harm is to dissolve the company. When a company does dissolve, or when a corporation does dissolve, they have to wind up, just like the partnership winding up period that we saw a little bit earlier when we were talking about partnerships and LLCs. Very similar. First thing, the company assets have to be liquidated, and creditors have to be paid off if they're paid. If there are no creditors, or the creditors are already paid, then the shareholders would get the rest of the money, if any. And then the company is terminated. The ending of the corporation is the termination, which occurs only after the winding up of all the corporation's affairs, the liquidation of it, and the distribution of proceeds to anybody who has a claim.
Our next discussion is about franchises. Franchises is a method by which a larger corporation has many different branches or many different operations or many different franchises that run a business that's really part of the larger organization, but also has some independence. Franchising, as you can see over here, is an important method of distributing goods and services to the public. One example, if there's a major chain restaurant like Starbucks or McDonald's or something like that, there is a central office that runs the show for the entire group, for the entire Starbucks, for all Starbucks, but the individual are run by franchisors, is run by franchises, and they own each individual business. Now they have an agreement, they have a management agreement with their parent corporation, but fundamentally they run their own businesses within, of course, certain contractual responsibilities that both sides have. A franchise is established when the franchisor, namely Starbucks, let's say, licenses the franchisee, which is the owner of the individual Starbucks, to use the franchisor's trade name, trademarks, commercial symbols, patents, copyrights, other types of property. Individual Starbucks, if I decide to open up a Starbucks in the mall and I get permission from Starbucks, the central agent, well, now I can use the Starbucks name, I can use the Starbucks logo, I can use the Starbucks trademark colors, I can use their recipes, I can use pretty much everything. I can call my drinks the caramel frappo, whatever, frappuccino, whatever. I can call anything because now I have permission to use essentially all of the Starbucks intellectual property. So the franchisor and the franchisee are usually established as separate businesses, separate corporations. There is the big Starbucks, and then there's me, who is just running the individual Starbucks with my own business. There are many advantages of franchising, and that is the franchisor can reach lucrative new markets. The franchisor, in other words, Starbucks, can, rather than having to go set up shop in far-flung places, if they want to open up a Starbucks, if they want to be able to tap the Nova Scotia market or the Bogota market or the Moscow market or whatever it is, it might not be that easy for them to go set up shop there. They might not know the local people. They might not really know what to do in that area. But if you get a local person to do it for you, then it becomes a lot easier. The franchisee, namely the person who owns the local Starbucks, has access to the franchisor's knowledge and resources. And the franchisee runs an independent business, and the consumers are ensured of uniform product quality because you have the same standards that are applied. Starbucks central office makes sure that its general quality control is applied in all individual franchises. Of course, it might not work 100% like that, but at least that's the theory. And of course, the central business can advertise, and this advertising now helps all of the franchisees. You've got, really, a franchise starts with a franchise agreement. And the franchise agreement has two parties. You've got the franchisor, who's the licensor, in other words, the person giving the license. Starbucks, the central component, the central agency in our case, gives me, the person who's running the Starbucks franchise, the license to use trademarks, service marks, trade secrets, and of course, more than just that, other things like patents, copyrights, whatever other type of intellectual property may be applicable. And there are many different types of franchises. One type of franchise is the distributorship franchise, where the franchisor manufactures a product and licenses somebody to distribute the product to the public. The example they give over here, Ford Motor Company manufactures automobiles, and franchises, in other words individual dealerships, are independently owned dealers, and they sell them to the public. There are many examples of food distributorship franchises, where you have a pretzel manufacturer in Pennsylvania that may make different pretzel bags, and then you have different distributors. Some actually might sell the exact same pretzel as Utz, whereas another distributor might sell the same product as hers, just based on who is the distributor. The distributor just gets permission from the central office to distribute these particular food products. So a distributorship franchise is simply where the central component makes it, and then the distributor has the ability to sell it down in the stream of commerce. Then you've got the processing plant franchise, where the franchisor provides a secret formula or secret process, secret recipes, and then the individual franchisee actually manufactures it. It's one more step removed than the distributorship. In the distributorship, the parent company makes everything, whereas in the processing plant, it's the parent company that just gives the recipe or gives the secret or gives the process to the franchise, and the franchise then goes ahead and makes the product. One example, of course, is that Coca-Cola. They license regional bottling companies to manufacture and distribute Coke. They give the Central Coke in Atlanta, may give some other bottling company in Connecticut or California or wherever the secret recipe, whatever that might be, and then they go ahead and use the secret recipe to maybe they give them even some ingredients or whatever it is, but the franchisor, in other words, the processing plant, takes the recipe, manufactures the product, and then goes ahead and distributes it or sells it themselves. Then we've got a chain style franchise, where a franchisor licenses the franchisee to make and sell its products from a retail outlet serving an exclusive territory. Here is the example of the restaurant franchise. Pizza Hut is the example they give over here. The one I was discussing before is Starbucks. Same idea, where it's not that the central Starbucks agency is actually making the coffee. They're not taking, in Seattle, they're not in that huge Starbucks building in Seattle. They're not sitting there and making 3 million gallons of coffee every day and then shipping it around the country. What they're doing is everybody is making the coffee, all the Starbucks are making their coffee in-house with their own machines, but Starbucks is just giving them the right to use the Starbucks intellectual property, maybe some recipes, logos, trademarks, whatever it is. And they also might give them an exclusivity within a particular area. They might say, okay, in this city you're the only one that has the right. Now, of course, if you've ever walked through New York City or some other big cities, you'll know that Starbucks doesn't have a very big exclusivity range. Very often you'll have Starbucks that are right across the street from each other or within a couple of blocks of each other. But again, that's up to the individual franchisor and franchisee agreement. There could be an exclusive territory, but there doesn't necessarily have to be an exclusive territory. Then there is the area franchise, where the franchisee is granted the authority to sell its own franchises, sometimes called a sub-franchisor. A franchise, for example, let's say Starbucks decides they don't want to have to control all the thousands and thousands of Starbucks that appear across the country, so Starbucks will say, okay, we're going to sell the right to run all the Texas Starbuckses to Texas Starbucks Incorporated. And then Texas Starbucks Incorporated will go ahead and hire or distribute to other franchises around the state. So in other words, you're giving the people the right not only to sell, but you're giving somebody the right to actually create and manage sub-franchises. So that's what franchises are. Now let's take a look at some of the rules that govern franchises. Many states have enacted statutes that require franchisors to make specific disclosures to the franchisees. You obviously want to make sure that the franchisees, the people who are going to be investing in actually building the restaurant or building the plant or building whatever the case may be, you want to make sure that they understand what they're doing. And the series of rules that applies to these is called the Uniform Franchise Offering Circular, or the UFOC. The FTC, the Federal Trade Commission, also has rules. Those are talking about state rules. State rules that the uniform rule is something that's enacted by various states. Then you've got federal rules that apply to franchises. And the FTC is the Federal Trade Commission, which of course is a federal administrative agency, and they require franchisors also to make pre-sale disclosures. So in other words, there are state rules and there are federal rules that require that the franchisee, the person establishing the franchise, will actually be able to understand what he or she is getting into. The franchisor has to disclose assumptions underlying any estimates and hypothetical data. For example, if I'm deciding whether to open up a Starbucks, and Starbucks tells me, well, you're going to probably make $100,000 a year for the first 5 years, and then when you really get rolling, you'll make $200,000. Well, how do they know that? So they have to give them the explanation for why they're making that assumption and how they know that that assumption is accurate. If projections are based on actual past data, then the franchisor has to disclose that data. Where did they get that data? How did they collect that data? And the franchisor has to provide a mandatory precautionary statement explaining that things aren't guaranteed and what the possible risks are. And what franchises are fundamentally about is intellectual property. So I'm going to discuss a little bit about intellectual property and the various types of intellectual property that exist and that are relevant to franchises. Intellectual property generally means property that is not physical. You've got physical property, which is real property, real estate. You've got personal property, which is movable property. And then you've got intellectual property, which is something where you own an idea or you own a process or you own something that may not be able to be held. The three major examples of intellectual property are patents, copyrights, and trademarks. Patents is a process, an invention, something like that. Copyright is a written work or a musical work or something to that effect. Then you've got trademark, which is something that indicates or is associated with an organization. You know, the Nike swoosh or the McDonald's M, or the baseball teams, the New York Yankees interlocking NY, something like that. Things that are recognizable to the public or to the people that symbolize a particular product. So a franchisor licenses the use of the trademarks in the franchise agreement. Anyone who uses the mark without authorization, and that's talking about people who are not franchisees or even that are franchisees but don't have the right to use something under a particular agreement, can be sued for trademark infringement. And the franchisor can recover damages or what is called an injunction, which is a court order for the other person to stop doing this wrongful infringement. In other words, a franchise agreement should say what the person has the right to use. Does the person have the right to use all the company logos? Does the person have the right to use some of the company logos? And exactly to what extent do you have to do that? And then there's something similar to a trademark called a trade secret. A trade secret is something that is not public knowledge. The classic example here would be the recipe for Coca-Cola. Coca-Cola, it's almost famous that Coca-Cola has this secret ingredient that they won't tell anybody and blah, blah, blah. But the franchisors, obviously, the distribution franchisors, or sorry, not the distribution, the manufacturing franchisors, the franchisees, the people who are bottling and making the Coke, obviously they have to know this ingredient, otherwise they wouldn't be able to manufacture it. So what if they go ahead and take this secret ingredient and they disclose it and they release it to the public? Well, that is a misappropriation of trade secret, and that would subject them to being sued. The franchisor can recover damages and obtain an injunction, again, which is a court order for them to stop doing it if anybody releases any trade secrets. In any franchise agreement, in any franchise relationship, first thing you have is a franchise agreement. An agreement is between the franchisor and the franchisee that sets forth the conditions of the franchise. Now, it can cover pretty much anything. If I want to open up a Starbucks, the agreement between Starbucks and I can cover pretty much anything. Usually it has some sort of a fee that I pay to open up. I pay, a $100,000 one-time fee, and I get maybe I pay a yearly fee also, and in exchange, I get Starbucks intellectual property. It may also contain things like quality control standards. Starbucks doesn't want just anybody to have their to have a Starbucks. If the franchisees do a bad job, well then the parent company is going to get a bad reputation. If I have a bad experience with the with the Pizza Hut in Dallas, well then I might be less likely to go to the Pizza Hut in Houston. So there may be terms in the contract that require a certain level of quality control. Same thing with training requirements, a covenant not to compete. In other words, the idea is if you have a Starbucks franchise, well, then you're not going to go turn around afterwards and open up your own coffee shop and use all the secrets that you learned as a Starbucks owner and therefore compete with other Starbucks. An arbitration clause, which is a very common contract clause in general, which says that in the event that there is a dispute, rather than going to court, you will agree to go to arbitration. Use of the franchisor's trade name, logo, and trademark, and conditions for termination of the franchise if that happens. The franchisee will typically have to pay a franchise fee. A franchise fee is established in the agreement. This may include an initial license fee to start, a royalty fee, which is a fee to use the intellectual property as you move along, an assessment fee, cost of supplies, lease fee. These are all different types of fees that a franchisee might have to pay in order to run an individual franchise. Well, now let's get to the end of a franchise relationship. How can a franchise be terminated? Well, it can be terminated for cause, which means for a good reason. It could be terminated at will if the contract allows it to be terminated at will, which means where either side can just end it right away without giving any explanation. And underlying both is the possibility of wrongful termination, which is when one side ends it illegally or against their agreement, and that might cause a lawsuit. Termination for cause means some good reason that the franchisor has for ending the relationship. This could be non-payment of a franchise fee. This could be continued failure to meet quality control standards. Really, it could be any violation of the franchise agreement. These are just two very common examples. Then there's termination at will. And even if the agreement between the franchisor and the franchisee gives the franchisor the right to end the relationship at will, many state and federal laws prohibit terminating the franchise at will because you don't want to allow the franchisor to take advantage of the franchisee. If I go and work very hard to run a wonderful Starbucks in this area for 5 years, then all of a sudden they shut me down and say you can't use the Starbucks logo anymore. But thank you so much for giving us all that free advertising and cultivating all these great Starbucks relationships in your town. We're going to open up a Starbucks next door. That's not really fair to me. So there are certainly federal regulations that apply to that. Wrongful termination occurs when there is no just cause for termination. Now, of course, if the contract expires, that's a different story. If the franchise was only established initially for a 10-year period and 10 years expires, well, then of course, then the franchise simply ends. But if the franchise agreement was perpetual and there's no good reason, a franchisor cannot simply cut off the ability of the franchisee to operate. And if it does happen, if Starbucks shuts down my coffee shop for no good reason, then I can recover damages based on this wrongful termination and by suing. In terms of the relationship between the franchisor and the franchisee is an independent contractor, which means that the franchisee is not an employee or an agent and is not liable and the franchisor is not liable for the franchisee's contracts and torts. If I am a franchisee and I own a Starbucks in New York, let's say, first of all, they don't pay me a salary. I earn my own salary. I may pay franchise fees, but the point is they don't have to send me a W-2 or any kind of tax form because I make my own money and I pay my own income taxes. I'm not an agent of Starbucks. I'm an agent of my own branch, of my own franchise, of my own venue, but I can't make contracts on behalf of Starbucks in general. If I make a contract with a coffee bean farm in Colombia to supply Starbucks in general with 100 tons of coffee beans per month, well, I may be liable for that, but the main Starbucks headquarters in Seattle is not liable for that because I don't have the authority to speak on behalf of the franchise. And the same thing is true with the contracts or torts that I commit. If I'm negligent and somebody ends up with a jagged piece of metal in their coffee and files a lawsuit against me, well, of course they can sue me, they can sue my franchise, but they cannot sue the parent company. They cannot sue Starbucks in general because I am not an agent of the Starbucks name. I am simply a franchise that has the right to market under their logo. Of course, each one of them, franchisors and franchisees, are liable for their own torts and their own contracts, but not necessarily of each other. Of course, I'm not liable for Starbucks' torts. If Starbucks gets sued for false advertising or something for putting on commercials on the radio that were inaccurate, well then just because I have a franchise doesn't mean that I'm personally liable. Neither of us are liable for the torts, the damages caused by the other. Licensing is really an element of franchising. Licensing in general is a business arrangement that occurs where the owner of an intellectual property, very often a trademark or a patent, could even be a copyright, contracts to permit another party to use that intellectual property. You can see why it's relevant to franchising, because if I have a Starbucks, I have the right to use all the intellectual property that goes along with that. Uh, Other types of agreements might be where I have the right to manufacture something with a patented process because I made an agreement, a licensing agreement, with the owner of the patent, with the person who filed for and secured the patent. That would be a licensing agreement. Another type of similar business arrangement is a joint venture. A joint venture is simply where two or more businesses combine to pursue a single project or transaction. Now, for purposes of everything we've discussed so far in these courses, they're really considered partners. They have fiduciary duties to respond to each other. They have to manage the business together. They're joint and severally liable. One example, I think AT&T and Bell South, I think it was, back, I don't know, 10, 15 years ago, combined and formed a joint venture called Singular Wireless LLC. Now I think it's no such thing. Now I think Singular Wireless might have become AT&T Mobility or something. I forget offhand. But the point is that two big companies, AT&T and Bell South, were two major companies, and they got together to try to join the cell phone market, join the wireless market, and that was a joint venture where they're not really becoming a single company, but they're working together on a particular project based on some sort of agreement. And a joint venture, as we discussed before, operates as a partnership. Each joint venturer, Bell South and AT&T in the example I just gave, is considered a partner, and therefore they're each liable for the debts and operations of the joint venture partnership, just like any other partnership. Just like we discussed before, when you're talking about a general partnership, each partner is liable. When you're talking about a joint venture, the same thing applies. Something that is not quite a joint venture, and certainly not a franchise agreement, is something that is called a strategic alliance. A strategic alliance is an arrangement between two or more companies in the same industry to achieve a particular objective. Again, it's not that they're forming a partnership or doing anything together specifically, they're just agreeing to work together on some particular facet. Lesson 8 is about corporate management. In other words, okay, we've got a corporation. Now what are some of the rules that govern its management from day to day? Well, we've got three basic components of us in the power structure of a corporation. You've got the shareholders who own the company, you've got the directors, and you've got the officers. Now, of course, both can be both. One person can play both roles, and we've discussed all this before, but now we're going to go into it in a little bit more detail about the roles of the various of these three different groups. Let's start with the board of directors. The board of directors are really in charge of the corporation, except some major decisions that are made by the shareholders. Some of the things that the directors do, they hold annual meetings. States actually require these annual meetings. They could be done live, they could be done by phone, they could be done by teleconference, but they do have to be done. They can call special meetings when there's something important that's going down in the company. They can create committees regarding particular issues that are important, study particular issues. They can hire and fire officers. The officers of the company, the executive officers, or really any officers of the company, serve at the pleasure of the board of directors. The board of directors can hire a president, and the board of directors can fire a president. And they can make recommendations to shareholders on major issues, like whether to dissolve, whether to merge, that sort of thing. Board action is accomplished by a majority vote, but in a subcommittee, if you have 9 members of the board and they say 3 people will study this particular issue, well, those 3 people cannot act on behalf of the board because you need a majority of the whole board. Corporate officers, on the other hand, are people that manage the day-to-day corporation. Examples, of course, the CEO, the Chief Executive Officer, the CFO, President, Vice President, in-house counsel. These are all people that are at the head of managing the company. They're not the directors. They don't make the major decisions, but they make the day-to-day operating decisions. Officers, one thing that distinguishes an officer from another employee, obviously the officers are employees of the company, just like people who work on the assembly line or the custodian or whatever. Everybody else who works for the company is also working for the company, but there are some distinctions between officers and directors. Officers and regular employees. First of all, officers have authority to bind the company. An officer can sign a contract and make an agreement on behalf of a company, whereas a regular employee, a lower level employee, cannot. Officer has speaking authority for the company. If an officer makes a statement, that is considered a representation of the company. The company could get in trouble for misleading or false advertising if an officer makes a statement that later turns out to be not true. And officers have an obligation to report to the board as the shareholders regarding the status of the firm. And the nature of this is governed by securities rules, the Securities and Exchanges Commission rules. Lower level employees may work for the company, they may get a salary, but they don't have a duty to report and they don't have the authority to bind the company with a statement that they made. Some other responsibilities are the fiduciary responsibilities. Now, these are owed both by directors and by shareholders, and we've discussed all of these before when we discussed partnerships, so some of this is going to be a little bit of review. This requires that officers and directors act with reasonable care and diligence. You have the duty of loyalty and the duty of care, and now we are discussing the duty of care. A breach of the duty of care, which means a breach of the responsibility to act appropriately, can be misfeasance, in other words, taking actions that are harmful to the company, taking actions that are unreasonable, buying things that are bad or objectively bad investments, not just bad judgments, but making decisions that are bad for the company. And then there's nonfeasance, which means failing to take action that a reasonable person would take. Misfeasance, for example, if I was in the board of directors of a coffee manufacturing company and I decided to buy a line of cars or a car dealership that I knew nothing about, but because I thought it was a good idea, that might be misfeasance, whereas nonfeasance would be, let's say, failing to file the tax return for the corporation on time that I was supposed to do, and because of that, the company got hit with a fine or the company got hit with some bad consequence. These responsibilities are objective, which means every corporate officer and director is expected to adhere to the standard that a reasonable person would normally be expected to adhere to. In other words, an officer and director is expected to have a reasonable level of competence in acting on behalf of the company, and it also takes into account the person's experience and training. Obviously, if a corporation hires an executive officer and pays that person a lot of money because the person has a PhD or the person has 20 years of experience managing companies, well, that's part of the reason why the person was hired. And because of that, that person now has a responsibility that is commensurate with the person's experience. If I'm a 20-year CEO and I make a bad decision, well, that might not necessarily have been such a bad decision if I were a rookie, but I'm not a rookie, and that's why I got paid the big bucks. CEOs very often of big companies get paid huge amounts of money, tens of millions of dollars a year, sometimes even hundreds of millions, and they get paid for that. Part of the reason is because they have this big responsibility, and if they mess up and they cost the shareholders hundreds of millions of dollars, they can get sued for hundreds of millions of dollars because the director officer will be liable to the corporation for harm suffered as a result of this breach of care. However, there is one major caveat to that, and that is the business judgment rule. The business judgment rule says, and it protects both directors and officers, it says that if the company makes a good faith decision that was based on due care, that was based on reasonable research, that was based on reasonable behavior on the part of the decision maker, and it turns out to go bad, just turns out to be a bad decision, that does not mean that there will be liability. It says if the director or corporate makes a corporate decision in good faith, the court won't second guess that decision. It would not be a good system whereby everything that turns out bad causes the corporate officer or corporate director to be sued for tens of millions of dollars because the shareholders lost that kind of money based on the stock going down. If that were the case, well, then no corporate director or corporate officer would take any risks. They would just be extremely conservative because they don't want to be sued. So the business judgment rule kind of encourages corporate directors and officers to not be reckless, but to be bold in their actions. And therefore, just because a decision turns out to be a bad decision does not inherently mean the duty is breached. So the business judgment rule applies in all cases. Just because you make a bad decision doesn't mean you're liable, except in some of these circumstances. Number one, where you haven't been reasonably prudent. If you haven't done your research, if you haven't done your quote-unquote due diligence, well, then you're not protected by the business judgment rule. Or if you haven't adequately researched the transaction, That also is a reason why the business judgment rule would not protect you. Again, if the business judgment rule doesn't protect you, well, then you can be liable as a corporate director or officer if the corporate shareholders lose money, which usually happens when you're talking about a bad decision on behalf of a corporation. It also doesn't apply when the officer or director acts in bad faith, in other words, knows it's a bad decision, or takes bribery or something to that effect. Certainly, a business judgment rule would not protect the officer or director. The officer or director has breached the duty of loyalty or has a stake in the transaction. Either of these cases. Duty of loyalty, like when we saw earlier, when you usurp a corporate opportunity, there's an opportunity that comes to your attention by virtue of the fact that you're an officer in the company and instead you take it for yourself, the business judgment rule doesn't protect you. When you have a stake in the transaction, if I'm the director of a company and I personally am selling a house to the company, well, then the business judgment rule doesn't protect me. There's a conflict of interest there, and the deal better be fair in order for me to avoid liability. Next, we move to the next set of players in our business drama, and that is the shareholders. The shareholders have many rights, of course, because really they own the company. Anybody can be a shareholder. It could be an individual investor. So if you're listening to this, you very well may be a shareholder of various companies. You could have private pension funds, state pension funds, 401ks, things like that, mutual funds, which essentially are professional companies that invest in various companies with many investors' money. Instead of investing yourself, you invest with a mutual fund, and the mutual fund manager decides which stocks to put all the money in. They could be other companies, could be employees of the company who are very often given stock or options in the company. These different investors, of course, each have their own unique set of concerns. However, the overall goal is, of course, to do what's best for the company in terms of the bottom line, in terms of the profit. They have to assert their individual voices to make their goals to make their goals have the best chance of being met. Now, of course, all shareholders get to vote on some key decisions, including electing the directors and deciding whether to merge, that sort of thing. So, the shareholders, aside from what they do, they also have rights. They elect single directors. That can be done in a single slate of directors sometimes, which means let's say there are 9 directors. They could all be elected in a single year. Or there could be a staggered board. For example, you could have 9 members on the board, but 3 elected each year every 3 years, almost like United States senators. They also approve or disapprove of fundamental changes. If the company wants to merge or the company wants to dissolve, the shareholders have to approve that. And they also have the right to vote at annual meetings on these sorts of questions, on these fundamental questions. And they are based on the record date. For example, if the annual meeting is on June 1st, well, in order to decrease confusion, let's say they'll say the record date is May 15th, so 2 weeks early. If you're a shareholder on May 15th, you get to vote, otherwise you don't. It would just be too complicated if you got your shares on May 31st and then to vote on June 1st. It would be virtually impossible to keep track of who has the ability to actually vote. Now, of course, a shareholder can actually come to the meeting, can come to the annual meeting and vote physically while there, but most shareholders in a publicly held company are not actually going to come to the meeting. Many, like if I'm a shareholder of Google, I'm not going to fly out to San Francisco or Mountaindale or whatever it is and vote in the Google annual meeting. I just don't have time, and most shareholders are the same way. So instead, what shareholders can do is they can give somebody the authority to vote their shares, and that is called a proxy. So a proxy is an authorization given by the shareholders to a third party to vote that shareholder's place. The person who's being appointed is also sometimes known as a proxy. In other words, I give a proxy to my proxy, and the proxy can then go ahead and vote whatever my shares are. Very often you'll have proxy solicitations. You'll get things in the mail, and the mail will say, we'd like you to vote this particular director. If you agree, then send in this form, and the form is a proxy form. It gives somebody the authority to vote your shares in a particular way. A proxy has the name of the shareholder, what the authorized vote is. It could be yes or no to an issue, or it could be unlimited discretion. In other words, you can give somebody the proxy saying you can vote whatever you like, or with my shares, or you can give somebody a proxy saying you can vote, but only if it's yes to question C. Proxies are the default rule is that the proxies are good for 11 months to cover only one annual meeting, although they don't have to be that way. It could be longer or shorter depending on what it says. Proxies are usually fully revocable, which means if you change your mind, if you give your proxy to somebody, the meeting is on June 1st, and you give your proxy to somebody on May 1st, and now it's May 15th and you change your mind, you can revoke your proxy. There are a couple of exceptions. Number one, if they're coupled with an interest, which means there's consideration. I gave my right to vote in exchange. Somebody paid me for my right to vote. Well, if somebody pays me for my right to vote, then it's a contract, and a contract can't simply be withdrawn just like that. Also, there could be a voting contract that can be specifically enforced. There also could be a voting trust, where a bunch of people, rather than having to worry about proxies and rather than having to worry about voting individually, they all pool their shares. So now they've got a block of, let's say, 100,000 shares that they can vote, and this is a way to gain more influence, rather than having if one person with 10 shares, which just doesn't matter that much. But all of a sudden, if this voting trust controls 100,000 shares, then all of a sudden its vote could mean a lot bigger. It could make a much bigger difference. Okay, why do shareholders own money? Well, the reason, of course, why do they own shares of the company? And the answer is because they want money. They want to get money from the company. And how do they get money from the company? Well, the first and most common way they do so is by getting dividends. The board of directors declares how much will be given on a per share basis. For example, if there are a million shares and the company makes $2 million of profits, well, the board can say, okay, we're taking that $2 million and giving it out to our shareholders, and therefore every person gets $2 per share. Or they can say, we made $2 million, we're going to keep $1 million in the company for future projects, but we're going to take the other million and give it out to our shareholders, and then the shareholders get $1 per share. So in other words, the board of directors decides when and how much to give as dividends to the shareholders. Of course, the board of directors wants to give more money to the shareholders because, well, it's the shareholders' money, but also because the shareholders will like them and more likely to vote for them. On the other hand, the board of directors might want to keep the money and for a rainy day, or keep the money in case they need it for whatever reason, or to start new projects. And so therefore, of course, the board of directors don't get to keep it personally. It would be in the corporate bank accounts. So this is just one of the decisions that directors have to make. Shareholders can also get money through a share repurchase plan, which gives options to shareholders to sell their shares back to the company. They don't have to have one of these, but sometimes companies want to consolidate a little bit, decrease the number of shares that are floating. So they might announce saying anybody that wants to sell the stock back to the company, will pay you $50 per share. And if they do that, and stockholders do that, well then of course they give up their shares and they get the money. There can also be a dissolution dividend, which means if the company goes out of business and there's money sitting there that's left after all the creditors are paid, well then that money, whatever's left over, is given to the shareholders because the shareholders are the ones that actually own the company. And finally, you have distribution of corporate property. If the company has, if it's a small company, usually this is relevant to, and the company goes out of business or the company stops operating for whatever reason, and it's got a desk, and it's got file cabinets, and it's got physical plant inventory, whatever it is, that's distributed proportionally among the shareholders as well. Shareholders also have some rights in the company, including the right of appraisal. The right of appraisal essentially is where shareholders have a right to ask a court to make sure that a transaction that was done with their shares, or their company really, was fair and made sense. So this applies whenever a corporation is dissolving or selling out to another company, like merging, being acquired, declaring bankruptcy, dissolving. In other words, something major, even changing a class of stock that affects your voting rights. You have a right to bring an action in court for the court to look over and make sure that you are not being treated unfairly. The shareholder, you have to have dissented from the action. In other words, if you voted in favor of the dissolution or if you voted in favor of the merger, you can't then turn around later on and ask a court to make sure it's fair because, well, you voted for it, so you don't have the right to challenge it. But so if you do that, and you can bring an action in court, if the court agrees with you that it's not fair, the court can actually order the company to change whatever policy was being challenged. How does a company make that? How does a court make that determination? How does a company make a determination as to whether a particular transaction is fair? And of course, the right of appraisal will be to try to make this determination as to whether something is fair value. Well, you have to look at a whole bunch of things. Again, here we're talking about a merger, we're talking about selling to another company. We're really talking about a whole variety of different types of of actions that could be ripe for appraisal. You have to look at the public price of a stock at the time of the transaction and during the preceding time. If the company was being sold out for $50 a share and the company's share price is now 48, but it's been 60 or 70 for the last 3 or 4 years, well then a court might say that this price that was being sold at now is really too low. You have to look at the price of the stock as paid by the purchasing company, any competing bids before the company sells out and merges. Was there a better option that the company should have taken advantage of? A professional valuation of the value of the company and its shares, value of the assets transferred. In other words, if the company was being bought and let's say it's an airline and there's value in the airplanes and the airport slots, that has to be included in this appraisal as to whether it's fair. The value of any shares that was being transferred, the overall economic health of the firm. In other words, a court will look into all of these things before making a determination as to whether a proposed transaction was fair. Okay, so the next thing is, we discussed many times that there is a limited liability when you're talking about a shareholder. A shareholder is not liable personally for corporate debts. There are some exceptions to that, and that's what I want to discuss now. And that is sometimes known as piercing the corporate veil. Piercing the corporate veil is when the court says, even though it's a corporation, you are still personally liable for the company debts. Now, that's not the normal case. The normal case is that there is limited liability. But piercing the corporate veil can happen when a court says that shareholders are personally liable for corporate debts. Here are a couple of examples of when that happens. Number one is the alter ego rule. The alter ego rule is when the court thinks that this corporation is really just a sham and the corporation really is just the shareholder. Now, this is not going to be relevant in a publicly held company, but if you have a private company with only one or two shareholders and the one or two shareholders don't really observe the corporate formalities and they do everything behind the company, and you think that the only reason why they formed the corporation is to limit their liability, then a court can eliminate or ignore the corporation. Really, if the entire driving force behind the corporation was a single or small group of people, and the purpose of forming the corporation was just to limit liability, and there was some sort of illegal or wrongful conduct. If the conduct was legitimate, then you're probably not going to have the alter ego be implied. But also, was there commingling of assets? In other words, did the person use one bank account for his own assets and one bank account for the corporation's assets? Well, that's more of a reason to keep the corporation. On the other hand, if everything was just commingled into one person's bank account, the court might say this was really a joke. The corporate formalities were not respected. Generally speaking, if you want the liability shield and you run a corporation, keep the formalities. Make sure you have meetings of the annual minutes of the annual meetings. Make sure that you do everything by the book. Make sure you issue shares properly. Make sure you keep separate bank accounts. Make sure you keep separate books. Pretty much make sure you do everything separately from yourself. Also, incorporation can be ignored if the corporation is used to hide wrongful activity. If you have a crime or fraud committed by an officer, director, or shareholder in the name of the company for his or her own benefit, the court can say you are personally liable for the results of that and eliminate the corporate liability shield. Then there are a couple of other scenarios in which the shareholder can be liable. Again, 99.9% of the time the corporate shareholder is not going to be liable for corporate debts, but here are some examples. If it's a closed corporation, in other words, if it's not publicly held, there are some rules saying that the shareholders, the owners, are liable for employees' wages. In other words, if the company didn't pay the employees' wages, then the individual shareholders have to. This is a rule to try to make sure that the employees get paid. It's not fair if the employees work and then they don't get paid, then the shareholders say, well, yeah, it's a debt of the corporation, but the corporation's going out of business and nobody has to pay it. So some states say the shareholders in a closed corporation are personally responsible for the debts that are owed to employees. Also, or if there's an interested or fraudulent transaction, interested means when the corporation and the director do business with each other directly. Again, as we discussed before, that's a breach of the responsibility of loyalty as well. There's also, if for an open corporation, in other words, for a corporation that's publicly held, then the liability of the shareholder would be to give back a dividend that was given improperly. A dividend can only be of corporate profits. If the company has no profits, the company's insolvent, the company doesn't have money, it's not allowed to give out a dividend. And if it does give out a dividend, then the shareholder has to pay it back. And finally, this is the idea of watered stock. Watered stock means if a person receives stock from the corporation for less than its fair value, because the directors wanted to give the person a gift, or there was some kind of a kickback going on, or whatever it is, then it has to repay the company for the reasonable value of the discount that it got. Because a publicly traded company is not allowed to play favorites. A publicly traded company is not allowed to give certain people one price and other people other prices. The securities rules say you pretty much have to treat everybody equally, and if you don't, you're going to have this watered stock concept. Now we turn to the idea of what can a corporate shareholder do if there's a problem with the way that the corporation is being operated by the shareholders or by the directors or officers. And the answer is they can bring what is called a shareholder derivative action. There's actually a special section in the Federal Rules of Civil Procedure, Rule 23.1, that discuss this idea of the shareholder derivative action. And the shareholder derivative action is brought by the shareholders when they want to hold directors responsible for actions that hurt the corporation. Now, the problem with suing the directors is that the corporation can't really sue the directors because the directors are the people that make the decision as to whether the corporation sues. So if the corporation wants to sue the directors, in essence, they would be suing themselves, which doesn't really make any sense. So therefore, the shareholders can sue on behalf of the corporation. The shareholders, on behalf of the corporation, file a lawsuit against the directors and the corporation. So really the corporation is both the plaintiff and the defendant, which is kind of weird, and that's why they had to make a special rule to establish this unique circumstance. So there is a procedure in this respect when you're talking about a shareholder derivative action. First, the plaintiff has to make a claim, make a complaint to the board, give them time to fix it. If there are disinterested directors, in other words, directors that are not being sued, there could be 9 directors on the board and only 2 of them are being sued, well, then the other 7 will study the merits of the lawsuit to see whether that's a good idea to allow it to go forward. If the rest of the directors think that the suit should go forward against these bad directors, against these rogue directors, well, then they can adopt the lawsuit on behalf of the company. Otherwise, it could simply be you can just let the shareholders continue to press forward the action on behalf of the company. So eventually it will go to court, and the court will make a determination as to whether there is merit in the cause of action, and if there is, then the court will compensate the shareholders who brought the suit in the first place and order whatever helpful action is necessary. Then we have this fiduciary duty of loyalty. We already discussed this, so I'm not going to discuss it in too much detail. Just like with a partnership, just like with an LLC, this duty requires the officers and directors to put the interests of the corporation above their own financial interests. And the way you go against that, and we've discussed this many times, so again, I'm not going to discuss it in too much detail, take a corporate opportunity for yourself is one way to violate the breach of duty of loyalty. Start a competing venture, in other words, go into competition with your own company, and engaging in an interested director transaction, which means something between you and the company. And if there is a breach of the duty of loyalty, a court can set aside a transaction, undo a transaction, establish a constructive trust, in other words, take the profits and hold those profits that were made by this wrongful transaction for the rest of the shareholders, and can even hold the director or officer liable for damages if the company was damaged. Lesson 9 is mergers, acquisitions, and hostile takeovers. This is where 2 companies merge into one company takes over another company, whether voluntarily or, believe it or not, involuntarily. So a merger is simply 2 or more corporations combining to form into one single corporation. When AOL and Time Warner merged and became AOL Time Warner, that was a merger. An acquisition is when one company buys out another company so that only one company now exists. When Facebook purchased WhatsApp, well, the whole thing became part of Facebook, although the app is still called WhatsApp, but still that was an acquisition. The difference is really just a formality. The only one major difference is that when you're talking about a merger, in other words, both of them essentially don't survive, become one hybrid company, the shareholders of both companies have to approve before the merger is actually done, whereas in an acquisition, when one company is taking over another company, the buying company doesn't need to put it to a shareholder vote, but the recipient company, the selling company, the company that is going to no longer exist, does need to put it to a shareholder vote in order for it to be allowed. A short form merger, on the other hand, which doesn't require the approval of either company in terms of its shareholders, obviously the management has to consent to it, is when one company that already owned a lot of another company, that already owned, let's say, 80 or 90% of the subsidiary company, just takes it over entirely. That is called a short form merger. In these cases, and whether we're talking, and this is a short form merger or a merger or an acquisition, the company that is surviving, whichever company that is, the purchasing company, the new company in a merger, the parent company in a short form merger, the parent company takes all the debts, rights, and responsibilities and obligations of both companies. In other words, if there's a merger, then whatever contracts each company had now become the sole responsibility of the surviving company. Other important things regarding corporations include something like a share exchange. A share exchange is a method by which companies are very often paid for. If Facebook wants to buy WhatsApp, for example, for $19 billion, well, people don't usually have $19 billion in cash. Even companies, even major companies, don't usually have $19 billion in cash. Apple might be one exception, but virtually all companies in the world don't have that kind of cash. When there's a merger and a company needs billions of dollars, it doesn't usually go to the bank and or write a check or anything like that. Instead, the way it pays for the new company is it gives the old shareholders, the shareholders of the old company, stock in the new company. For example, if WhatsApp was, let's say, was being bought for $19 billion, what Facebook did, I'm sure, is it gave the owners of WhatsApp $19 billion worth of Facebook stock. They didn't actually give $19 billion in cash. If they're both publicly held companies, if, when American Airlines and US Air merged, or when two other big companies merge, rather than the individual shareholders of each company getting cash for whatever stock is being purchased by the parent company, instead they get stock in the new company. People who own stock in US Airways instead just got American Airlines shares that were worth the amount of whatever the purchase was. Dissolution, on the other hand, is when a company simply stops operating. If the company does stop operating, any kind of a company, publicly held or not, does stop operating, so whatever is left, whatever assets there are, that could be inventory, it could be goodwill, it could be intellectual property, it could be pretty much anything, is used to pay whatever creditors, and the rest, if there are and if there is any money left over, then those are used as dividends, as dissolution dividends. Dissolution dividends are dividends that are paid off to the shareholders after the company stops operating. A consolidation, very similar to a merger, occurs when two or more corporations combine to form an entirely new corporation. And in this case, the articles of incorporation of the new corporation replace the articles of incorporation of the two old corporations. Essentially, a merger and a consolidation are pretty much the same thing. And as we discussed before, an ordinary merger or a share exchange requires the vote of both sets of shareholders. It requires originally the recommendation of the board of directors of each company, because any major company, any major undertaking of a company first is going to be decided by the board of directors, and the board of directors will make a recommendation to the shareholders to adopt it. But the shareholders have to vote by majority vote, and usually this is done through a process of proxy system where voters don't actually come and vote particularly, but they give people their proxies to vote to uphold to approve the merger, let's say. And when that happens, then the acquisition or the merger, the consolidation, whatever it is, can take place. So you need the affirmative vote, yes vote, in other words, of the majority of the shares of the new corporation. If the merger is approved, or if the consolidation is approved, so the articles of merger or the share exchange are filed with the Secretary of State, and now instead of two corporations of that state, it is now one corporation of that state. There's also the purchase of all assets. The purchase of all assets occurs when a company, instead of merging and buying the company, instead of actually purchasing the company itself, it simply purchases the company's assets, purchase the company's inventory. If I want to buy an airline, for example, I can buy the airline, or I can buy all of the airline's airplanes, and all of the airline's pilot contracts, and all of the airline's airport slots, and whatever other assets there are, instead of actually buying the company. Now, the advantage of this is that you don't have to take on the contracts. If there's an airline that has all sorts of debts, well, if I buy the airline, I'm going to take on those debts. But on the other hand, if I just buy the airplanes and I just buy the airport port slots or the fuel or the hangars or whatever else the airline owes, well, then I'm not buying the whole company, and therefore I'm not buying the debt as well. Now, a court can look at a transaction and say this was really a merger, and you're just phrasing it as a purchase of assets in order to avoid taking on the debts. And in that case, the court can actually say this is more like a merger and we're going to hold you liable for debts. But that doesn't always happen. Sometimes if you have a company that has a lot of debts or has bad contracts, you may just want to buy their assets rather than buying the entire company. The next subject is, of course, relevant to mergers and acquisitions, and that is the hostile takeover. Now, owing to the nature of a publicly traded business, it is possible to take over a company even though the board of directors doesn't want you to. Of course, that's not possible when you're talking about a private company. When you're talking about a private company, unless the government steps in and requires it for some reason, you can't buy the company unless the owners are willing to sell. But because of the fact that when you're talking about a public company, it's not really owned by the directors are just kind of in charge of it, it is possible to take over a company without the consent of the board of directors, and that is called a hostile takeover. So this occurs when a person or group wants to take over a company without the consent of the board of the target corporation. Now, there will be many different possibilities as to when that might happen. One possibility is the company isn't doing that well. The company has more inherent value, but the stock price is low because of mismanagement. And so other companies look at it and say, if we buy that cheap, if we buy that for, not as much money because it's not doing so well, maybe we'll turn it around and we'll be able to buy it for cheap and then make more money. Also, corporations with large stockpiles of cash are attractive takeover targets. Sometimes companies want to invest, but they don't have the money. Now, if they don't have the cash. Now, one thing they could do is they could sell, they could float more shares, they could take out loans, they could issue bonds, but these are all complex and they might not want to. But they also might look around for other companies with cash. A company might be worth $100 billion and see another company worth only $10 billion and say, yeah, but that company that's worth $10 billion has $2 billion in the bank. So let's go take over that company, and then we'll take that $2 billion and be able to use it towards our infrastructure projects. Whereas we, even though we're worth $100 billion, might not have $2 billion in cash assets. So those are different reasons why there might be a hostile takeover in the first place. Now, in terms of a policy reason to allow hostile takeovers, why doesn't the government just say this is not fair and we shouldn't allow hostile takeovers? Well, there are a few good reasons. Number one, the threat of a takeover keeps management in line. If the directors know that if they don't do a good job with the company, other companies are going to take them over, and probably once there's a hostile takeover, they're going to get rid of the board of directors and get a new board, and they're going to lose income. That's a good reason for them to try to keep their company competitive. Also, and by the same token, a hostile takeover and a merger causes a little bit more efficiency. Maybe they'll decrease the number of higher management because now there's less to manage. So those are the pros, but that, of course, is the other side of the coin is the managers who are those managers or some managers may lose their job because if you have two companies and they merge into one, there's a lot of duplication that they might be able to get rid of, so it can lead to layoffs. The battle can be costly in terms of the hostile takeover battle that we'll discuss shortly. It's often executed by greedy corporate raiders who don't care that much about the company's business, but they just want to make a profit. Basically, corporate raiders, people who make money doing this, can buy companies and then turn around and sell the stock for more, especially if they know how to manipulate the market. There were some movies like Wall Street that were, based on corporate raiders, and there were real life corporate raiders too. And they also this idea of green mail. Green mail essentially is when a corporate raider starts to take over a company and buys up some stock and starts the process of a hostile takeover. And then the board of directors is so desperate to get rid of them and keep their jobs that they agree to pay the corporate raider more value than the in order to have the corporate raider go away. Like for example, if the corporate raider buys $1 million worth of stock and is threatening a hostile takeover, they might pay the corporate raider $2 million just so that the corporate raider will stop. They call that green mail. Nothing inherently illegal about it, but it's just not really the most efficient thing for a company to have to spend its operating money on getting rid of corporate raiders. So, how do you go about doing this? How do you go about enacting a hostile takeover against a company that doesn't want to be taken over? Well, one thing you can do is you can just simply buy the company, buy a controlling block. It could be 51% of the company. Certainly is a controlling block. But even without 51%, you can buy enough to effectively be able to control the company. Remember, not everybody actually votes in these things, so you don't actually need 51% of the company to control it. You may need 30% or 35%. The point is you need a lot. And this makes it not the most efficient way to enact a hostile takeover if the company is a very big company. It takes a lot of money, and also it requires all sorts of sort of SEC filings when you're buying so much stock of a single company, and which means that while you're doing this, the directors will know what's going on, and they may try to stop the hostile takeover. The other two possibilities, number one is a proxy contest. A proxy contest is probably the most common type. And then the proxy contest is where you go directly to the company shareholders. You don't even deal with the board of directors necessarily. You go to the company shareholders and you use your advertising or whatever it is to try to convince them to elect a new board of directors that is friendly to you. And then once the board of directors is friendly to you, once you become the board of directors, then you can pretty much do what you want for the company. It's much less expensive, but also you don't have as much control. It's not like you can just throw cash at it. You have to convince the shareholders to vote for you, and they might or might not do so. You can also do what's called a bear hug. A bear hug is when you just offer so much money, you make them an offer they can't refuse. You offer, if the stock is worth $30 and you offer $50, the offer might be so high that the board of directors might feel under tremendous pressure to accept it, because if they don't accept it, the shareholders may get very upset at them for not, for costing them money by not taking a higher offer. Again, the advantage of that is that it's not as contentious. You don't have to fight SEC filings. You don't have to have a media campaign. But on the other hand, it's the most expensive. You're going to end up paying more than you do if you try a proxy contest or buying up the company yourself. You're going to end up paying more per share. Part of that is what is called a tender offer. A tender offer could be either one. A tender offer is really part of the bear hug strategy of a hostile takeover. It doesn't even have to be hostile. A tender offer is an offer that's made to acquire the target corporation, and you go directly to the shareholders essentially, and this would have to be done through an advertising campaign where you tell the shareholders, okay, we're making this particular offer. And I mean, this is basically the way it works in terms of a diagram. The target corporation is the one that you're trying to take over. So rather than going to their board of directors and asking them to accept or asking them to recommend a merger, instead you just go directly to the shareholders and see if the shareholders will sell you their shares of the company. Now, these are regulated. These are very heavily regulated by the Williams Act of 1968, which is an amendment to the SEC Acts, and it requires certain disclosure requirements. In other words, if you're going to go directly to the shareholders, you need to explain to them certain things about what the consequences of the merger will be, because the fear is obviously that you'll just say, well, you're going to make all this money, and the shareholders don't really fully understand, and don't. If you go to a board of directors, well, the board of directors are professional, and they'll hire people that will do a due diligence and try to make sure that it's a good idea. But on the other hand, the shareholders might not be that sophisticated, and so therefore there are more heavily regulated rules that apply to tender offers than they do than there are when you go directly to the board of directors. And there are some specific rules. There's the fair price rule, which, well, you can probably figure out what that says. A rule that says any increase in price paid for shares must be offered to all shareholders, even if you previously, even if, like for example, if you make a tender offer and then 10% of the shareholders sell to you, and then you make another tender offer and you get another 10%, if you increase the price between the two tender offers, then the first series of recipients, the first series of shareholders that sold out, have to get the same price as the second. The idea is you can't. It wouldn't be fair to pay people just because they're more gullible to get them on the first, because you get them on the first tender offer, so that they should lose out. There's also the pro rata rule, which says that shares must be purchased on a pro rata basis if they're tendered. You can't buy just from some shareholders. If a person owns 1,000 shares and another person owns 10,000 shares, you have to buy them proportionally. You can't a tender offer which goes again. This it's not you're not talking about buying individual shareholders that you can do without a tender offer. That has nothing to do with it. A tender offer is something that's open to all shareholders of a company, so it has to be proportional. It has to be fair. And there are also anti-fraud provisions that are relevant to tender offers. It prohibits fraudulent, deceptive, and manipulative practices, and of course violations. And it's beyond the scope of the course to go through the specifics of those kinds of rules, but the point is there's very heavy regulation with regard to tender offers and with regard to dealing directly with shareholders when you're talking about trying to take over a corporation. Now, what can a board of directors that realizes or thinks it's about to be subject to a hostile takeover attempt do? Again, we're talking about a bear hug, we're talking about a proxy contest, we're talking about a tender offer, we're talking about the company trying to buy up shares. These are all different methods of a hostile takeover. And so what can the management of the board of directors of the target company do to try to prevent this? Because again, you have to realize if once there is a merger, they're probably going to lose their jobs. And even if they don't, it won't be their company anymore. So one thing they can do is they can propose a plan of their own. If it's a tender offer or if it's a proxy contest, they can explain to the shareholders why the shareholders are better off leaving them in charge. We're going to turn around the company doing XYZ. They can also try to find a white knight, which is an alternative buyer. If they're worried about the corporate raider or the purchaser being somebody that's bad for the company, well, they can try to find somebody else to step in that's more friendly to this board of directors and buy the company instead. That's a simple alternative to being taken over. Instead of being taken over by somebody that's hostile, you try to get somebody who's less hostile to take over to buy your company in the first place. You can also stagger the board, which many companies do. Instead of having let's say there are 9 directors, instead of having them all 9 elected every year, say have 3 of them elected every year, so that it's harder to, let's say, for example, get a proxy contest when you have to convince shareholders to vote for you in 3 different elections. It's much harder to do that, obviously, than it is to do it all in one election. One other thing you can do is you can adopt what is called a poison pill. A poison pill is kind of a strange mechanism. There's no law about a poison pill. Some smart director thought of it at one point, and what a poison pill essentially says, as the name indicates, is that if you take over the company is going to be worthless. And the way it does this is it says something like this. It says, if we get taken over, then every shareholder has the right to buy shares at 1 cent each. Can buy, 1,000,000 shares at 1 cent each. Now, if that actually comes to fruition, and the provision actually goes into effect, well, then the company's going to get destroyed because now the company's shares are going to be worth 1 cent. If the company shares were worth $80, but there's a provision saying that if they get taken over, now all of a sudden they can buy shares from the company for 1 cent, well, then the market value of those shares becomes 1 cent, and once the market value of the shares is worth 1 cent, the whole thing becomes a joke, and the company will fall apart. So the idea of that is to try to make sure that people don't is that you make sure that the corporate raider or whoever is trying to enact the hostile takeover doesn't actually commit the takeover, doesn't actually do the takeover, because if they do, they're going to be destroying the company that they purchased. Very often, this is done as leverage. You don't want to do it. You don't want to be stuck with a poison. You don't want to if you're worried that somebody's going to take over your company, you don't simply always want to resort to this tactic, because then the shareholders will know that you're incompetent and you have to resort to these kinds of tactics in order to prevent a takeover, and you don't want to do a good job managing the company. So they'll probably vote you out of office, and people won't invest in you if they think that you lack self-confidence to the extent that you have to do a poison pill. So instead, very often this will be kind of a negotiating tactic. A company will adopt a poison pill, a provision that says that if we get taken over, all these rights provisions kick in that are going to destroy the company. But they can negotiate with the company trying to do a hostile takeover, and if they come to an agreement, well, they can always rescind it, just like a board of directors can adopt one of these shareholder rights provisions that essentially is a poison pill. It can also cancel it. One time, the dead hand poison pill, which courts have not allowed, is when a board of directors tried to enact a poison pill that only they could undo. And the court said that's too much of a restriction. So again, it's a little beyond the scope of the course to go through in detail, but the poison pill is a strategy by which you try to prevent a hostile takeover by causing the takeover to trigger a shareholder rights provision that would make the company worthless if it actually establishes. And here are some other examples in terms of fighting a tender offer or fighting a hostile takeover. I think some of this, so you can try to persuade the shareholders that you're right. You can file lawsuits for. You can try to find ways to file lawsuits and tie the thing up in court. You can sell a crown jewel. In other words, sell a good part of the company to make the company less valuable, to make the person trying the hostile takeover take pause. You can adopt a poison pill, as we discussed. You can find a white knight. You can do a reverse tender offer, where you try to buy the remaining shares from the shareholders yourself, rather than letting the corporate raider do it. You can issue additional stock. You can create an employee stock ownership plan, and various other things. You can pay off the hostile takeover wannabe. And these are some of the things that we've discussed in terms of how you can fight a hostile takeover attempt. Next chapter is about securities and securities regulation. Security essentially means something that is publicly traded in the open market, usually a stock, but it could also be something like a bond. Until 1929, securities were pretty much unregulated, which means pretty much anybody could sell any stock they wanted on the open market, and there wasn't much in the way of government regulation. And all that kind of led to the stock market crash of 1929, which led to the Great Depression. Until 1929, the stock market was doing very well throughout the 1920s. The 20s were called sometimes the Roaring Twenties because the economy was doing so well, but a lot of that was based on a mirage. A lot of that was based on the idea that these stocks were overvalued, and people didn't realize how the underlying companies really weren't worth as much, because the companies didn't really have to provide any information. And that all changed with the securities rules that were passed in 1933 and 1934. These were called the SEC Acts. They created the Securities and Exchanges Commission, the SEC, and also provided a bunch of rules regarding how you can sell securities in the open market, how you can sell stocks. The goal of the securities rules is really about disclosure and accuracy. Disclosure in making sure potential investors, including banks, mutual funds, and individual investors, know a lot about the information, know a lot about the stock, know a lot about the company before they actually decide to invest. And number two, that the information that is put out by the company is accurate. The goals are to assure accuracy and completeness of information given to the public, organize a system where there should be full disclosure of accounting information, companies' profits, companies' losses, companies' expenditures, and to regulate forms in which securities are exchanged. In other words, to try to avoid companies being worth more than they're actually worth because of bad information that is given to the public, or because of a lack of information that's given to the public. And these are administered by the SEC. The SEC was first created in these acts of 1933 and 1934, and of course exists to this very day. The SEC, the Securities and Exchange Commission, is a federal administrative agency run by the executive branch of the government. That what it does is it enforces and administers federal securities rules. It can adopt rules and regulations to interpret and implement federal securities laws. Federal securities laws are fairly complex, but the securities that they govern in the entire stock market is almost infinitely more complex, and so therefore the SEC has to make judgments on the fly and pass regulations, as many administrative agencies do, to make sure that the goals of the securities rules, and to make sure that the uh, enforcement is up to standard. It can investigate securities violations. It can bring enforcement actions. In other words, it could bring actions against people who allegedly violated the securities rules. And it can also regulate activities of securities brokers and advisors. So let's take a look a little bit more in terms of what securities are and a little bit in terms of details of the securities rules. We could spend whole courses on securities, so obviously we're not going to discuss it in too much detail, but we'll discuss kind of a brief overview, a little bit of a survey of some of the securities rules. First of all, in order for the Securities and Exchanges Commission Act, or the SEC Act, to apply, it has to be a security. That's the first thing. So, I guess the first thing you have to do is define what a security is. A security is any interest or instrument that is a common stock, preferred stock, a bond, debenture, or a warrant. We discussed what bonds and debentures were. Those are debts of the company that are being sold to individuals, when basically an individual is lending money to the company. A stock, common stock or preferred stock, is a share of the company's ownership. And a warrant is really a right to buy a stock at a certain price within a certain period of time. Kind of like an option, but, well, a little different. We don't have to go into that in too much detail, but the point is something like, well, you may have heard warrant in terms of a search warrant. This is an entirely different type of warrant. A warrant may be a right to buy a particular stock at $10 anytime over the next year, or something to that effect. Very often they come with stocks. When you buy a stock, you may also buy a warrant, depending on the company, but that's essentially what a warrant is. It can also be an interest or instrument that is expressly mentioned in the Securities Act, or it's an investment contract. These are all examples of securities that are regulated by the SEC Acts and the SEC. So, the Securities Act of 1933 regulates the issuance of these securities. And what it says is that when you're going to issue a security, in other words, when you're going to start selling things in an open market, you don't have to worry about the SEC. You don't have to worry about the securities rules if you're just a private company. You have to worry about other rules, of course, but you don't have to worry about securities rules because you're not being sold on the open market. If I, on the other hand, have a private company and I want to start issuing these shares to the public, and issuing these securities to the public, well, then I have to start worrying about securities rules. And that's because Section 5 of the Act says that securities that are offered to the public through use of mails or any facility in interstate commerce, which of course in today's day and age includes computers and includes the internet, includes pretty much anything you can think of, because the internet does go in interstate commerce. When the Act of 1933 was originally passed, as hopefully you can understand, there was no internet, so they couldn't really discuss the internet in 1933. But the point is, you do have to register with the SEC before you issue any of these securities to the public. And the way you do that is through a registration statement. A registration statement is filed with the SEC. It contains information about the securities to be issued. And what the SEC is looking for is not whether it's a good stock, it's not whether people should buy it or anything to that effect. That's the sort of thing that the individuals will decide, so that's not the sort of thing the SEC really worries about. What the SEC does worry about is whether the issuer has met the disclosure requirements. In other words, that the issuer, the seller, has to establish that the securities disclosure requirements, statements that are required to be made to the public, are actually done. Then you have what is called the offering process, sometimes referred to as the IPO process or initial public offering process. And the way this is, if I have a company and I want to start issuing shares in public, like Facebook did a few years ago, like many of the big companies have done, they are originally private companies that are held by a few individuals, and now all of a sudden they want to start selling stock on the open market in order to make a lot of money, and very often these companies do make a lot of money, hundreds of millions or even billions of dollars by selling stock. So there's a process. Now it's a complicated process. It may cost $10 million in legal fees and in the fees of investment banks who actually set up the offering process. But if you're going to make $200 million or $1 billion, then it may be worth it to spend $10 million to law firms and investment banks to help set up this process. So the process is, first of all, disclosure, which is a full and complete disclosure of all sorts of information to the SEC and to the public of the company's finances, business, prospects in the future, and the organization of the business. It requires that the company get its books in order and make sure the accounting is up to date through a whole series of complex rules that govern securities. And once it does so, it can go public, and it has to issue what is called a prospectus. The initial public offering is the process by which the stock or the security is originally offered to the public, and they have to create a prospectus. Now, if you've ever invested or if you've ever seen a company that was invested, you may have heard of this prospectus. A prospectus is usually a long document, and the document gives all the disclosures. Sometimes these companies will say, read the prospectus carefully before you invest. Now, most people don't actually read the prospectus carefully before they invest, but the point is this information is there. And it's one thing if you're going to invest a couple of $1,000s, you're probably not going to bother to spend 5 hours reading the prospectus. But if you're a mutual fund manager and you're thinking of investing, $25 million in the company, well then there's more of a reason to read the prospectus carefully before they invest. And this contains all of the information that is necessary. It has to be looked at. First of all, it has disclosures, explains how the company is organized, gives investors information. It has to be read and approved by the SEC. The SEC hires people that sit there and read prospectuses to try to make sure everything is appropriate and everything is disclosed and everything is discussed. And a prospectus is a disclosure. A prospectus is not an advertisement. It's not to try to condition the market. The idea is if a prospectus is too much of an advertisement, if it's trying to be an infomercial, if you're trying to sell the company in the prospectus, well, the SEC might say, rewrite this paragraph. Don't write about how great you are. That's not the purpose of a prospectus. If you want to run a commercial or if you want to advertise, you can go ahead and do that. But that's not the place of the prospectus. The place of the prospectus is to explain to the public what is going on. There is one section called the management's discussion and analysis where the management is allowed to speculate a little bit as to the prospects of the future, but it can't be too much like an advertisement or the SEC is going to make you rewrite that paragraph. So let's go and continue with our discussion of the IPO. You've got the issuance. This is once the SEC sees the prospectus and sees your plan for an issuance, and it gives the approval. The corporation or its investment bank, that's what investment bank is very often, that's the service they provide. If you're a company, you probably don't have the ability to market things to the public because you just don't have the mechanism by which you're going to be able to sell things to the public. So you go to an investment bank, it might be Salomon Brothers or Merrill Lynch or something like Goldman Sachs, something to that effect, and they take care of it for you. They will, I don't know if they'll help you write the prospectus. I think that's really the job of the law firm that you hire to comply with the SEC rules. But once the prospectus is written and everything is ready to go, the investment bank will then set the initial price and start selling things to the public. And then we've got the next stage. Next stage, you start with the pre-filing period. Then you have to wait for the approvals, and then the post-effective period. Let's look at these one at a time. You've got the pre-filing period. This is when the issuer contemplates offering securities, and ends when the registration statement is filed with the SEC. Now, this is really the initial stage. You're still kind of looking into it. You're talking to the lawyers. You might not even be dealing with the investment banks yet. You might be considering hiring them, but the lawyers are probably drafting up the prospectus and making a determination of whether it's worth it to sell these things on the open market. During this period, you can't sell because you haven't gotten approval from the SEC yet. You cannot condition the market. You can't, in other words, tell everybody in the market that this great new stock is coming because the SEC hasn't given you permission to sell this thing or to advertise this thing. And so to start advertising it would be jumping the gun and would be premature and would be the sort of thing the SEC would frown upon because it's against the law. And you can't even engage in a public relations campaign to pump the value of the stock. Then you've got the waiting period. This is when the Registration papers have actually been filed with the SEC, and now it's kind of a matter of time before it gets final approval to actually issue these things in the open market. At this time, you can start advertising. You can condition the market, you can distribute the prospectus, and then finally, when you're ready to go, this is when the post-effective period, this is when the registration actually becomes effective, and the securities can now be traded on the open market. During this time, of course, and you can run ads. You can see this term over here, tombstone ad. That just, generally means a relatively simple newspaper or magazine ad. You can run other types of ads too. You can pretty much you can write and you can advertise however you like, as long as you don't say false things, and as long as the prospectus itself doesn't condition the market. Your other advertising can, of course. I mean, whenever you're trying to sell something, whenever you're trying to say this security is a great security, well, you can advertise and you can build up and you can try to condition the market all you like, because now you're actually selling the stock. And selling stock that should have been registered with the SEC and was not is actually a crime. There's criminal penalties, and any investors, in other words, if you float this stock to the public without getting permission of the SEC, without filing the appropriate documents, then not only can the investors sue for their money back, the person who did it can be subjected to criminal penalties. Somebody who does, and this applies pretty much for other securities regulations as well. If there is a violation of the SEC Act of 1933, that imposes civil liability, which means somebody that was victimized by this failure, who purchased the stock or who lost the money in a transaction, they can file lawsuits. And this applies whether they actually bought stock that shouldn't have been issued, or whether the stock should have been issued and was issued properly, but there was material information that was missing from the prospectus. Any of these circumstances allows a lawsuit, allows a cause of action. The SEC itself can also enforce securities rules, as we discussed before. It can issue a consent order. In other words, it can order a company to rectify certain behavior, adding things to the prospectus, stopping to sell certain securities, whatever remedy they want. Now, the SEC in and of itself cannot actually force a company to do something, because the SEC is not a court, it's an administrative agency. But what it can do, it can order somebody to stop, and then if they don't, they can bring an action for an injunction, or they can ask for other relief. And like I said before, the Department of Justice, which is also a federal agency, can bring criminal prosecution against people who violate securities rules. And now I want to focus a little bit more on some of the minutiae of the securities rules. That was kind of an overview, and let's take a look at some of the most important and some of the most commonly discussed types of securities rules. First of all, over here we've got Rule 144A, which is trying to increase the liquidity, which means the ability to buy and sell easily, of registered securities. And this permits qualified institutional investors to buy even unregistered securities without the holding period necessary, based on the idea, assuming these securities will eventually be allowed to be sold to the public, some institutional investors don't necessarily need the same kinds of protections as ordinary investors would. They go in there with their eyes open much more, and so therefore the rules are a little bit more relaxed regarding some of them. Some securities are exempt from registration and don't have to go through this long, onerous, and expensive process. This includes securities issued by any government in the United States, such as state bonds, federal bonds, things like that. Short-term notes that have a maturity that doesn't exceed 9 months. In other words, if I want to sell short-term debentures or short-term bonds that are only 3 months long, I don't have to go through the whole process. Securities issued by non-profit issuers, like charities, organizations. If they want to sell a certain security, or like usually bonds, or securities of financial institutions that are regulated by the appropriate banking authorities, on the idea that, let's say a bank's stock, they are regulated anyway, so there's no need to increase the second level of regulation regarding the securities. Other examples include securities issued by common carriers. These include certain things like railroads and utilities, and the reason for this is that they are, in any case, regulated by the Interstate Commerce Commission. So again, for the same reason regarding issues of the bank securities, we don't want the SEC to overly burden a particular industry. So if they're already being regulated by another industry, by another watchdog group anyway, there's no point in doubling the regulation. Insurance and annuity contracts by insurance companies, again, they're also very heavily regulated by insurance laws. Stock dividends and stock splits, and securities issued where one security is exchanged for another security. These things were already, 7 and 8 were already covered by the SEC. When they were originally sold to the open market, they had to go through the entire IPO process. So again, just because they split their stock, and split stock usually means they divide off one stock into two stocks and they're worth less, or they do a reverse split where two stocks are combined into one stock, and there are various price reasons why they do that we don't really need to get into right now. Basically, if they get too expensive, the stock goes too high, very often they'll split. If it gets too low, very often they'll do a reverse split. But either way, you don't have to go through the whole process again. The first part of the lesson dealt with the SEC Act of 1933, which was mainly about the offering process. In other words, how companies were able to actually start offering their securities on the open market in the first place. Now we're going to shift gears a little bit and move to the Securities and Exchanges Act of 1934, which regulates the actual trading of the securities. It regulates the securities exchanges themselves, brokers, and dealers who sell and buy in securities. And, of course, it calls for civil and or criminal liability for anybody who violates these SEC rules. And we're going to discuss a few of these selected rules. And the first one, probably the most all-encompassing one, is Rule 10b of the Securities and Exchanges Act of 1934, which prohibits the use of manipulative and deceptive devices in the purchase and sale of securities in contravention of the rules and regulations. This is extremely complex. It may seem pretty simple that you're not allowed to be manipulative, you're not allowed to be deceptive, but those terms are extremely vague and extremely broad. And there's reams and reams of regulations, SEC opinions, and case law on exactly what it means to be a manipulative and deceptive advice. And we're going to discuss some specific underlying rules that are passed based on this Rule 10b. Remember, Rule 10b is a statute. It's part of the SEC Act of 1934 that is currently in the United States Code. And then there are regulations. Regulations under the SEC Acts, which are passed by the Securities and Exchanges Commission, which are passed by the SEC, since it has the authority to pass regulations under the securities rules. And we're going to discuss some of those, and specifically we're going to look at Rule 10b-5. Rule 10b-5 is a regulation, not a statute. In other words, it was actually written by the SEC, but it is completely enforceable nonetheless. And what it does, what 10b-5 does, is it prohibits insider trading. Insider trading is, well, it prohibits more than insider trading, but let's focus on insider trading for a minute. Insider trading means when an insider makes a profit by personally purchasing the shares of a corporation prior to the release of favorable information, or by selling shares of the corporation prior to disclosure of unfavorable information. The proper price for a security would be, it wouldn't be fair, essentially, for somebody with insider knowledge of what's going on with the company to leverage that inside knowledge in order to make trades ahead of the open market. If I work for a big company and the company's stock value is trading at $50 a share, and I know that we're about to announce a major acquisition that's going to cause the stock price to go up, and I turn around and buy the stock beforehand, well, then I'm getting an unfair leg up on the market. I'm getting an unfair advantage over other people who would be considering investing in this security, because I have insider information, which allows me to know information that the general market doesn't. So that's considered not fair, and that is considered insider trading under Rule 10b-5 of the regulations that are passed under Rule 10b of the securities rules. First of all, what is an insider? Well, an insider is somebody who essentially works for the company, an officer, director, or employee of the company. a lawyer, accountant, or consultant, or somebody who is hired by the company to work for the company and therefore gets this information, and or somebody who owes a fiduciary duty to the company, somebody who maybe is an independent contractor working with the company, an auditor for the company, somebody who, by virtue of their relationship to the company, has some sort of inside knowledge that the open market does not have access to yet. And this can also lead to quote-unquote tipper and tippee liability. A tip is, in this context, an illegal piece of information that is given by somebody that has insider knowledge to somebody else. The tipper is the person who discloses material non-public information, and the tippee is someone who receives material non-public information. A while back, many years ago, but still a while back, Martha Stewart, who was famous for having these cooking shows on TV and whatnot, she actually got arrested, and she actually spent some time in prison for insider trading. She was a tippee. The allegation, which eventually was proven and she was convicted, was that somebody with insider knowledge gave her information, and because that a company called Imclone, which she held stock in, was going to announce something negative, and because of that she got out ahead of the market and sold her stock. It wasn't for that much. I mean, it was for, I think, about $40,000, which is a lot of money, but to Martha Stewart, who's a multi-millionaire, it's really not as much money. But still, regardless of how much money you have, you're still not allowed to make a profit based on inside information. And because she was able to sell because she got a tip, this was considered insider trading, and she was actually sent to jail for a few months because of it. If somebody does violate the SEC Act of 1934, and we discussed insider trading, but there are many other rules that are also prohibited, many other actions that are also prohibited by the SEC Act of 1934, there are various remedies that are possible. There are private actions. In other words, other investors, or people who were hurt by this person who used insider information or used manipulative or fraudulent tactics, can file a lawsuit for whatever damages they suffered. And there are all sorts of other remedies a court can enforce. The SEC can enforce with a consent order, as we discussed before. They can order somebody to do something. They can get an injunction, which is a court ordering somebody to, let's say, not make a trade, seek a court order, insider trading sanctions, or even criminal penalties. And there are also these treble damages, 3 times profits, which are really separate from criminal penalties, so I'm going to separate them over here. But treble damages is something that people can be liable for if they violate the SEC Act of 1934, which essentially means they have to pay 3 times the value. It's a special penalty that's established based on that. There's also criminal liability, as we discussed before. And under a much more recent rule, called the Sarbanes-Oxley Act, this was passed in, I believe, 2002. Individuals can be fined up to $5 billion and imprisoned by up to 25 years, or corporations can be fined as well, for violations that constitute violations of the SEC Act of 1934. Now, Sarbanes-Oxley, or Sarbox as it's called, expanded government regulation of securities, but one of the things it did is it provided for these sorts of criminal penalties. A similar rule to insider trading, really a rule that's made to back up the insider trading rule, is Rule 16a, which is the short swing profit rule. The short swing profit rule is something that essentially allows the government to deny somebody profits who may have had insider information, even if it cannot actually be proven that they did. So Rule 16a defines any person who's executive officer, a director, or 10% shareholder as an insider. And what it says is that if one of these insiders makes a transaction of the company's stock within 6 months of something that causes a fluctuation in the stock, then essentially they have to give back their profits to the company. This is one of those things where even if you can't prove that they actually knew any information, the suspicion, if they made some sort of a major deal and this company's stock goes up and an insider had bought shares 3 months ago and then they turn around and sell them, well, then they basically have to give back their profits to the company. It's a mechanism by which sometimes you just simply can't prove that they had insider information. You can't prove that they engaged in insider trading. But in order to prevent that possibility, the law says that you can't even, we're not even going to allow you to make profits within the short term because the suspicion is too high that you may have secretly had information that caused you to profit on the expense of the other investors. There are even states' securities rules. State securities rules have are not as comprehensive as federal securities rules, but they can increase the requirement of various companies in terms of the disclosures that they give to the investing public. But again, generally speaking, because the securities markets are traded in interstate commerce and are very comprehensively involved in interstate commerce, you're mostly talking about federal law when you talk about securities regulations. And finally, I want to quickly go over the securities markets. Now, a company that is traded in public doesn't necessarily have to be traded on the market. It could be traded over the counter, which is done privately and without an exchange. But what an exchange is, it is a place or an online place that facilitates the easy transfer of shares. These securities exchanges are very heavily regulated by the SEC and have to be proven by the SEC to allow people to exchange and to trade in their markets. Some examples include the New York Stock Exchange, the American Stock Exchange, the NASDAQ, or the National Association of Securities Dealers Automated Quotation. These are all things that in the old days were actually done physically, at least not the Nasdaq, but the New York Stock Exchange in the old days, if you wanted, I guess in the old days, if you wanted to, if you had 100 shares of Coca-Cola that you wanted to sell, you'd go down, you'd have to tell a broker, or somebody who had a seat on the New York Stock Exchange would come out onto the floor and say, I have 100 shares of Coca-Cola, anybody want to buy it? And then somebody from across the room would say, yeah, I want to buy it, and that's basically the way it would work. Now today everything is more automated. You don't have to, I guess people, they still do yell on the floor of the stock exchange. If you go for a tour, you can actually look down on the floor of the stock exchange during the day, and people are still yelling. I don't know exactly what they're yelling about, since everything can be done by computer, but I guess they figure out a way to yell anyway, reason to yell anyway. But the point is, these are methods by which which stocks are traded. Now, stocks can be traded without an exchange, but it's a lot easier, and the market is much is much more comprehensive when you're trading on an exchange than when you're trading over the counter. And the end of our course, the last couple of lessons, is a foray into a new area of employment rules. Obviously, employment rules are very heavily related to business law, and even though it's not really necessarily about business organizations, as we've been discussing until now, because of the fact that people who are in business and people who are practicing business law have to deal with employment law a lot, we figured we'd append it to the end of this course and make it a component of this course. And we're going to discuss employment law in two basic chapters, two basic lessons. The first one will briefly go over some of the basics of employment, and then we'll discuss some of the concepts of employee benefits, of what employees get in exchange for their work, and then we are going to discuss employment discrimination a little bit later on. First of all, we've got the concept of an at-will employee. In many states, an employee, unless stated otherwise, unless the employee has a contract, is inherently considered an at-will employee, which means the person is only there as long as the company wants the person hired. An employer in an at-will state, or if there's no contract that says otherwise, can fire an employee at any moment, really for any reason. So this is an at-will employee is somebody who does not have an employment contract, and that person can generally be fired. However, there are some times or some reasons that you are not allowed to fire somebody. And we'll discuss that more when we discuss discrimination, but there are discriminatory reasons you're not allowed to fire somebody. There are reasons, for example, you can't fire someone because they went and joined a labor union. You can't fire someone because they're a whistleblower. There are many rules that we'll briefly cover a little bit later on in the next lesson that are relevant to why an employee cannot be fired. However, the default rule, and the thing that's important to realize, is that a person can be fired at any time for pretty much any reason, as long as that reason is not contrary to law. You don't necessarily have to have established that somebody did a bad job, although it always helps if the person sues you for discrimination, and having evidence the person did a bad job is certainly something that may help with that. There are some exceptions. There are statutory exceptions. In other words, there are laws that say that you can't be fired for reason XYZ. There are contract exceptions. In other words, you might have made an agreement with the company to be there for a certain number of years or to be there for a certain number of months or that you wouldn't be fired without cause. There could be tort exceptions where the employer is doing something to damage you. And there could be public policy exceptions where a court can say we think that for the good of the public policy, we really ought to prevent people from being fired based on this particular reason. Okay, let's switch gears a little bit over here, and now I want to discuss some things regarding employee benefits. And the first employee benefit I want to discuss is workers' compensation. Workers' compensation acts were based on the idea back in the old days, back in the late 1800s, early 1900s, if somebody got injured on the job, they were in the factory and they worked 12 hours a day and they took home enough for their family to survive, and then one day they got injured by a machine at work and then they couldn't work and then they were home and their family starved. Well, when they started to make labor laws, they realized that that wasn't a very good system. So states have established workers' compensation routines. Now, workers' compensation is a state issue, so it does vary from state to state. The state you're in will may be very different from somebody else's state in terms of its workers' compensation plan, but all states have at least some element that to protect people who get hurt on the job. So, and these people are the people who get hurt on the job are paid according to preset limits established by the state statute or by regulation of a state administrative agency. The way workers' compensation works, fundamentally, is that states require employers to pay for workers' compensation insurance. Now, that may vary. Obviously, if you're a skydiver, you're probably going to have to pay more for premiums and workers' compensation insurance than if you're a desk clerk, because skydiving is a little bit more dangerous than sitting there at a desk and answering telephone calls. But employers are required to purchase workers' compensation from an appropriate agency that that will pay out if the employee gets injured. So then the employee, if the employee gets hurt, then the employee will be able to collect workers' compensation insurance money. So to recover the workers' compensation insurance, the worker's injuries have to have been employment related. And stress, and just because it doesn't mean that a brick has to fall on your head. Something like stress, carpal tunnel syndrome, even migraine headaches or things like that that are caused based on the fact that people are sitting there at keyboards and staring at their screen for 9 hours a day, could be considered valid reasons for workers' compensation insurance to kick in. Once that happens, then of course the insurance company has to pay premiums to the worker for when the worker can't work. Workers' compensation, however, is an exclusive remedy, which means if the worker gets injured, migraine headache, carpal tunnel syndrome, a brick fell on the worker's head, whatever it is, they can't sue their employer separately. Because if they could sue their employer separately, essentially they would be double dipping. There are workers' compensation rules that say if you get injured, you get this amount of salary for the amount of time that you can't work because you're hurt, because you're on the shelf, you get paid still, but you can't sue separately, except where the employer intentionally injures the employee. When you're talking about an intentional tort, well, workers' compensation insurance doesn't cover that. Workers' compensation insurance is meant to be innocent injuries, even negligent injuries, perhaps, but it's not really a matter of fault, by the way. It doesn't if it's the employer's fault or the employee's fault, it doesn't really matter that much in most cases when you're talking about workers' compensation insurance. It's like automobile insurance. Now the premiums might go up if it's your fault, whatever it is, but it's like automobile insurance where you get paid by your insurance company if you get into an accident, even if it was your fault, because that's the whole purpose of it. It's statutorily mandated, and it's designed to protect everybody, whether it's their fault or not. So now let's look at some of the other employee benefits. And these are usually passed by federal law, sometimes by state law, but there are a whole bunch of them. Again, at the turn of the 20th century, in the early 1900s, people were working for very little, and children were working for very little, and people had virtually no benefits, no protection if they got hurt, no negotiating leverage with employees. It was pretty much laissez-faire, and if people were happy to have a job, and there was really no power that they had, and no law that protected them. So employment laws have been, are passed constantly almost, and many of these help improve the lot of the workers. One example was OSHA. OSHA is the Occupational Safety and Health Act, and this was enacted to promote safety in the workplace, and it established the Occupational Safety and Health Administration, another federal administrative agency called OSHA, and it requires certain workplace safety standards. It applies to private employers. Government employers are exempt, although they may have their own rules based on the state's rules. But what OSHA does is it imposes record keeping and reporting requirements regarding safety and safety conditions. Requires employers are required to post notices informing employees of their rights. If you work and if you go to your work, you might see, if you look around carefully, like in the break room or whatever it is, you'll probably see all sorts of notifications posted regarding your rights. These are required by OSHA, and they're empowered to administer the act and to pass regulations, just like we saw before when you're talking about the Securities and Exchanges Commission, where they were allowed to pass regulations to enforce the securities rules. Well, OSHA is allowed to pass and enforce regulations to protect workplace safety. And these require safety standards on the part of employers. So there's a specific duty standard, which addresses a safety problem of a specific duty nature. So in other words, that there are particular industries that face certain hardships or face certain dangers, and they can make regulations saying a company that does that works with jackhammers has to give everybody goggles and has to train everybody for 7 hours before they actually go ahead and do it, whatever the case may be. And then there are general duty standards, which say that the employer has to provide a work environment that's free from recognized hazards that are causing or are likely to cause death or serious physical harm. And of course, it's a lot more complex than that, but those are just some of the basics of OSHA. Now let's continue with various other employee benefits rules. Let's start with the Fair Labor Standards Act, passed as part of the New Deal back in the 1930s under President Franklin Delano Roosevelt. The Fair Labor Standards Act was designed to increase working conditions, help people in general, decrease some of the abuses in the employment world. It prohibits child labor to some extent. Now, children under 18 can still get working papers, they can still work part-time, whatever it is, but it prohibits the kind of child labor that existed beforehand, where little children, 7-year-olds, 8-year-olds, 9-year-olds were sitting there working 12 hours a day in factories. That sort of thing is prohibited. It establishes minimum wage requirements, which exist to this day, although there's a lot of controversy about whether the minimum wage is high enough. And it establishes overtime pay requirements to many companies in many fields. As far as child labor law goes, well, the FLSA, Federal Labor Standards Act, prohibits the use of oppressive child labor, and it's also unlawful to ship goods produced by businesses that use oppressive child labor even overseas. And the Department of Labor has a whole series that defines the standards. Again, within certain limitations, children can work, but those are strictly prescribed. If anybody's had any experience when they were younger of trying to work when they were teenagers, you had to go get working papers, and once you did, you were only allowed to work a certain number of hours. During the school year, you had to work fewer hours. During the summer, you were allowed to work a few more hours, but there were very strictly enforced child labor laws. This also includes overtime pay, which if you work more than a certain number of hours per week, which again can vary by industry, but some of the rules require a certain level of overtime pay. Managers and administrative people are very often exempt. That's why CEOs can work 60, 70, 80 hours a week and not necessarily be subject to overtime requirements. Maybe they're probably getting paid enough that they don't have to worry about those sorts of things anyway. But other types of administrative works, like attorneys who work for law firms, are not subject to the overtime rules. But the overtime rules essentially say is that employers are required to pay more than a certain percentage more than the normal wage for overtime. Employers are also required to pay workers at least the minimum wage for regular work hours. The minimum wage is set by Congress and can be changed. Employers are permitted to pay for students. There are actually some industries like the service industry. Waiters can get paid less than minimum wage because the idea is they get tips which make up for that. And there are certain, maybe apprentices, people who are students, interns, can actually not get paid at all sometimes. But generally speaking, unless you fall under one of these exceptions, you have to be paid more than the federal minimum wage. Right now, I believe that's $7.25 an hour. There's a lot of proposal to increase that. But the other thing is that states can have their own minimum wages. There are some states which have minimum wages in some areas as high as $15 an hour. So the federal minimum wage is the minimum for the entire country, but then states can increase that a little bit, and many states have. Some states have actually made rules that say it depends on where you are in the state. Oregon has a minimum wage scheme, I think, that they were looking to pass. That if you're in Portland, you have one minimum wage, but if you're out in the country where things are less expensive in general, you actually have a lower minimum wage. An employer can reduce minimum wage by an amount that's equal to the reasonable cost of food and lodging. If you put an employee up, or you give the employee lunch, you can subtract the normal amount, the value of that, based on the idea that this is a benefit that's being provided for the employee. Overtime pay, as we discussed, is that an employer cannot require non-exempt employees. Again, there are a lot of employees, administrative people, white-collar professionals who are exempt, but you cannot expect them to work more than 40 hours a week unless they're paid 1.5 times their regular pay for work in excess of 40 hours. So if you have an assembly line worker who's getting paid $20 an hour, if they work 50 hours a week, well, the first 40 hours can be paid at $20 an hour, but the last 10 hours in the given week have to be paid at $30 an hour. And each week is treated separately. So just because an employee only works 30 hours one week, that doesn't mean you can give the employee 50 hours the next week without overtime pay. And regardless of how many hours the employee works in the other weeks, every time the employee works more than 40 hours in a given week, you have to get 1.5 times the normal rate. Some other employee benefits include the FMLA, or the Family Medical Leave Act, and this doesn't apply to all companies, but it applies to big companies. It applies to employers with 50 or more workers, federal and state and local governments as well, and it also requires that an employee has to have worked for at least a year and have had worked at least 1,250 hours in the previous 12-month period. Generally speaking, assuming a 40-hour week and 50 weeks a year, you're talking about 2,000 hours of work being approximately the standard full-time job. So 1,250 is not exactly full-time, but it's pretty close. Somebody works more than 1,250 hours is considered, at least for these purposes, for FMLA purposes, to be considered a full-time employee. And the rule is, regarding FMLA covered employees, is that based on a medical leave, or based on one of these events, the employer has to give the employee at least 3 months, or 12 weeks, which is essentially a little less than 3 months, unpaid leave. Of course, the employer is free to give paid leave, if the employer wants to, but that's not what's required of federal law. What's required of federal law is unpaid leave, and this includes things like birth of a child, and this applies both for the mother and the father, placement of a child for adoption or foster care, serious health condition, or for care of a spouse, child, parent with a serious health condition. So if an employee has no more sick or vacation time and needs to take up to 12 weeks for maternity, paternity, or a serious medical condition, or whatever it is, the employer has to allow up to 12 weeks of unpaid leave. Again, the employer can pay it, but the employer doesn't necessarily have to pay it. You do have to allow the person up to 3 months of unpaid leave for one of these situations. After the person comes back, then the person has to be restored to the same or equivalent position, has to be given equal pay of seniority, but doesn't have to be given seniority. In other words, if the person had been working for 3 years, then the employer doesn't have to start the person's 4th year for seniority purposes until the person comes back. But the point is, the person cannot be punished or penalized for going out for up to 3 months. More than 3 months, the employer could say, listen, I'm sorry, I can't have you work here anymore. If you're going to be taking off 6 months or 7 months, I have to get somebody else to replace you, and your job might not be here. 2 more quick discussions of employee benefits. We've got COBRA, which was passed as really part of the Consolidated Omnibus Budget Reconciliation Act. It sounds like a mouthful. This is there now in COBRA. The most famous parts of COBRA is regarding health insurance. Health insurance says that the employee has to be offered the opportunity to continue a group health program after the person leaves the company, and the the employee actually pays it, but it also has to be a part of something that is run by the company. And it's fairly complex in terms of how COBRA works, but the point is when a person leaves a company, a person has to have the ability to continue health coverage. Now, COBRA itself, the idea of the words Consolidated Omnibus Budget Reconciliation Act is just a budget bill. Omnibus means like a very big and comprehensive budget bill. Every once in a while, Congress passes these budget reconciliation acts where to establish or update the federal budget. And one of the things that one of these budgets did was it established this requirement. And finally, we've got ERISA, which is the Employer Retirement Income Securities Act, which establishes record-keeping and disclosure, requirements for vesting, and percentages of assets that can be invested in employers' securities. When I say employer securities, I mean employer stock. This thing regulates, when you're talking about company retirement plans, 401k plans, pensions, things like that, there are certain requirements that the employer has to establish in order to have this be a complying retirement plan for the employees. There are disclosure requirements, there are record-keeping requirements, there are requirements for vesting. Basically, vesting is a mechanism by which a company can say you can only participate or get benefits from the company's retirement plan if you've been with the company for a certain period of time or you meet certain other requirements. And there are limitations on what an employer can do to avoid making it too onerous or too unfair on the employee. And it's the last thing over here. A company can't, for example, we're going to say we're going to tie 100% of your pension to the company's stock. It's just too risky. Some of these were updated after the Enron situation, where Enron, which went out of business, I think in like 2001 or so, or 2000, was a huge company, and many of the employees had hundreds of thousands of dollars in Enron stock that comprised their retirement plan. And unfortunately, when the company went bankrupt, these people lost their entire retirement plans. ERISA is a very complex set of rules. There are I actually happen to know an attorney who basically does nothing but ERISA, works for a big firm, and the firm makes a lot of money on helping employers comply with ERISA. But ERISA again is a federal statute that establishes the sorts of rules that govern employees' pension and retirement accounts. And our final lesson is employment discrimination, obviously also relevant to employment law. And here are federal legislation, and maybe some state legislation as well, that prevents employers from discriminating against people for a variety of different reasons. The origin of all this was the Civil Rights Act of 1964, which we're going to look at. Before then, it was pretty much, there was no federal regulation against employment discrimination, and there was a lot of employment discrimination out there. Discrimination based on race, discrimination based on religion, and federal law and many state laws have been trying to do whatever's possible to try to minimize that, although it probably can never be completely eliminated. The equal opportunity in employment is the concept of the right of all employees and job applicants to be treated without discrimination and to be able to sue employers in the event that there is discrimination. This is enforced by the EEOC, or the Equal Employment Opportunity Commission. This is a federal administrative agency that's responsible for enforcing employment discrimination laws. They can conduct investigations, do their own interpretations, encourage conciliation, and bring a lawsuit. The EEOC cannot actually punish employers. The EEOC cannot actually bring a judgment because they're not a court. They can, however, investigate complaints, try to convince the employers to come to a settlement, or if that fails, or if they don't think a settlement is a good idea in this case, they can file lawsuits to try to enforce the equal opportunity laws against employers. These equal opportunity laws are based on many statutes, but the grandfather statute, so to speak, was the Civil Rights Act of 1964. Title VII prohibited job discrimination in 5 protected classes: race, color, religion, gender, or national origin. Before that, there was really no law differentiating based on these things. Now, this doesn't apply to every single employer. It really only applies to a little bit larger employers, employers with 15 or more employees. It also applies to employment agencies, labor unions, state and local governments, and most federal government employment as well. So most medium or large companies are governed by the Civil Rights Act of 1964 and Title VII, which prohibits employment discrimination. What it does is it applies to any term, condition, or privilege of employment and says that you can't discriminate based on those categories: race, religion, color, gender, national origin. You can't discriminate in any of those things in terms of hiring and firing. You can't fire people or hire people more because they're of a particular race or a particular gender, whatever it is. Work rules, promotions, compensation, job training, all of these things are subject to the civil rights rules. And a Title VII employment discrimination action can be based on disparate treatment or disparate impact. Disparate treatment is when an employer intentionally treats people differently based on one of those criteria. So this is where you're talking about an individual, and disparate impact occurs when an employer discriminates an entire protected class, even if the law does not specifically intend or specifically state that it applies to a particular class. For example, as we'll see a little bit later on, let's say you have a test that you give to all employees and say, well, every employee has to take the test in order to get a job, and it turns out that this differentiates by eliminating a much larger component of one race than another race. Now, as we'll see a little bit later on, if it's directly related to the job, that's one thing, but if it has nothing to do with the job, if you, for example, write a test that you know that 80% of white people are going to pass and only 50% of black people are going to pass for whatever reason, and that has nothing to do with your job. You're hiring people to manage your food store, and the test that you give them is on complex mathematical algorithms or whatever it is. One thing has nothing to do with the other. That could be considered a disparate impact discrimination. Although, of course, if there is a direct relationship between the test and the job, then even if it has a disparate impact, there may be a justification for enforcing it. In order to bring an action under Title VII through the EEOC, there are some steps that an alleged aggrieved employee has to take. First, a private complainant would file with the EEOC, file a complaint with the Equal Employment Opportunity Commission. Then the EEOC is given the opportunity to sue on behalf of the complainants. For example, the EEOC can take a look at this and say, okay, well, we agree with you. We think you were discriminated against, and we're going to file a lawsuit. And of course, if that happens, well, then the EEOC will pay for the lawsuit and has a lot of resources. So obviously, that's probably the best scenario for the employee. If the employee, except for the case being settled where the employer gives in to the employee's demands, I guess that's the best case scenario. But the next best case scenario is where the EEOC says, yes, we agree with you, and we're going to file a lawsuit against your employer on your behalf. The EEOC might not think maybe it doesn't have the resources, maybe it's busy with other things, maybe it doesn't think that the cause of action is meritorious, maybe it doesn't think there's any evidence of discrimination. So if the EEOC, for whatever reason, chooses not to bring the lawsuit, it will issue a right to sue letter to the complainant. In other words, hey, complainant, person making the complaint, we're not going to file a lawsuit in your behalf, so now if you want to, you can bring your own lawsuit in federal court or even in state court, depending on the circumstances, and then the employee can either sue and go to court and see what happens, or not sue or try to settle, whatever the case may be. If there is a judgment against the employer for discriminating on one of these bases, well, then a successful plaintiff can recover back pay and reasonable attorney's fees. So let us now cross over to the idea of, okay, what is considered discrimination? Well, first, we've got race, color, and national origin discrimination. I'll call it race discrimination for short, but of course it refers to all of these. Title IV, the main reason why it was passed, it was part of the civil rights legislation, part of the Civil Rights Act of 1964, and it was intended to prohibit employment discrimination on the basis of race, color, and national origin. Race refers to categories of individuals based on, I guess, physical characteristics. Color obviously refers to the color of a person's skin. National origin is the person's ancestry or the person's cultural characteristics. Now, once the law was being passed, then the government figured, all right, listen, once we're trying to prevent discrimination on the basis of race and color and national origin, we might as well extend it a little bit. And so therefore they also prohibited discrimination on the basis of gender. And this applies equally to men and women and is very often used. So men can use it if only women are being hired. Women can use it only if only men are being hired, or not even a matter of only. If a company, if it can be established by a pattern, or even by an individual incident, or by somebody who, by if they get a smoking gun, they get somebody in an email saying I don't want any women for this job, or I don't want any men for this job, or whatever it is, they can bring an action for discrimination based on Title VII of the Civil Rights Act. And then the last category is religion, where Title IV also prohibits employment discrimination based on a person's religion or religious practices. Now, that doesn't mean necessarily that an employer has to allow a religious person unlimited flexibility. If a person's religion, for example, says, well, I'm not allowed to work during the daytime, and so therefore I'm not coming to work any time for the next, as long as I'm with the company, well, obviously you can't expect an employer to be able to run a business like that. But an employer does is not only not allowed to discriminate based on religion, the employer also has to reasonably accommodate an employee's religious practices and observance if it doesn't cause an undue hardship on the employer. For example, if a person can't work on Saturdays and the company's normally open, well, then the employer would probably have to allow the worker to work a different day instead, maybe work Sundays instead, or something to that effect. On the other hand, if the job is a college football announcer where the games are all on Saturdays, well, then the employer doesn't have to make that kind of accommodation because it just simply doesn't make any sense. The whole business would be the whole effectiveness of the employee would be wasted because of the employee's religious beliefs or religious practices. Okay. Then now let's take a look at the opposite side of the coin, the defenses to a Title VII action. And there are a few others that we're going to discuss, but merit means where you say, well, it wasn't because you were a particular race or religion or gender that you got fired or didn't get a raise. It was because you didn't deserve it, or you did deserve to get fired, or whatever it is. Seniority. You are allowed to run your business based on seniority, give people who are there longer the better treatment, regardless of what their race or gender is. And finally, you've got the old BFOQ, or bona fide occupational qualification. A bona fide occupational qualification means, okay, yes, we're discriminating based on gender, yes, we're discriminating based on race, yes, we're discriminating based on religion, but that's because a particular race or religion is necessary, or a particular gender is necessary for this kind of job. So it's lawful if it's job related and it's a business necessity. If you're, for example, hiring a Christian pastor, well, I think it's pretty much common sense that you need somebody who's Christian to be a Christian pastor. So it's the sort of thing where if you're hiring a model for women's clothing, well, then you need women to model women's clothing. So that's the idea where you're saying, yes, I'm discriminating, but I have a reason why I need to discriminate, and that's called a bona fide occupational qualification. Okay, so now let's turn to some of the overarching principles and some of the rules regarding employment discrimination that have been passed separately from the Civil Rights Act, and some of these things will be part of the Civil Rights Act. First of all, we've got the Equal Pay Act, which was actually recently, just a few years ago, there was a separate this Equal Pay Act, the Lilly Ledbetter Equal Pay Act. And what this does is it protects both genders, both sexes, from pay discrimination based on gender. What this says is that if you have jobs that have equal skill, that require equal effort, equal responsibility with similar working conditions, and you have male and female employees that are doing the same things that are similar, you have to give them equal wages. Now, it's hard to enforce these things, obviously, because it's hard to prove equality, but there can be cases, and have been cases, brought to enforce that. Why would you be able to justify a difference in wage if you have men and women, for whatever reason, getting different, or people of different races getting different treatment? Well, as we discussed before, you've got seniority or merit, just like with race discrimination. Quantity or quality of the product produced. If one person is better at producing, then that person can obviously get a different wage. And any factor other than gender can be used to justify a difference in wages, but the employer bears the burden of proving these defenses. So, for example, if you establish that other people, the people that men are getting one wage and women are getting another wage, the employer's got to figure out a way to prove a justification for that distinction. There's also the ADEA. The ADEA is the Age Discrimination in Employment Act. And the Age Discrimination in Employment Act is similar to the race-based employment laws. And what this does it prohibits age discrimination in employment decisions, including hiring, promotion, payment of compensation, other terms of employment. And this was based on the idea that there is discrimination sometimes where people want younger workers because people are worried that older people are not going to be as energetic, or they're going to retire sooner, or they're not going to be able to work as much, whatever it is. And these are this is what the Age Discrimination in Employment Act is based on. It only applies to employees who are 40 years of age or older. If you're 38 or 39 or 21, for example, you can't. If you're too young, that's not a good enough reason to sue. If you say, "Well, I'm 19 and therefore I'm getting discriminated against," too bad. You're not protected by the Age Discrimination in Employment Act unless you're over 40. It covers employers who cannot establish mandatory retirement ages. Covered employers, can't establish mandatory retirement ages. You cannot say, unless there's a really good reason, unless there's a BFOQ, which we discussed before, unless there's a bona fide occupational qualification that requires that people of a certain age can't do a job for whatever reason, you cannot establish minimum retirement ages. And it's also administered by the Equal Employment Opportunity Commission. Establishing mandatory retirement ages would be unfair because just because a person is 66 or 67 or even 70 years old doesn't inherently mean they can't do most jobs. Now, if the person is simply not able to do it anymore for whatever reason, it requires physical strength, and now a 75-year-old just doesn't have the physical strength, well, then of course you can fire that person. You can lay off that person simply because the person can't do the work anymore. That's not what age-based discrimination means. Age-based discrimination means discriminating against someone based solely on their age. Another very important statute that's relevant to employment discrimination is the Americans with Disabilities Act, or the ADA, and this imposes on employers, and not just employers, also providers of public transportation, public accommodations, to accommodate individuals with disabilities. That's one reason why you see ramps and elevators, handicapped parking spots in most public buildings that were built after a certain date. Basically, there are older buildings are grandfathered; they don't have to be knocked down and rebuilt. But newer buildings, even buildings that are not owned by the public, buildings that are office buildings, are required to have certain disability accommodations. And Title I of the ADA prohibits employment discrimination against people who are qualified but have disabilities. And it also, just like with religion, Title I requires an employer to make reasonable accommodations that do not cause undue hardship to the employer. Installation of an elevator, installation of a ramp, installation of a special workstation. If it doesn't cause a huge undue burden to the employer, then the employer has to make the accommodation. Reasonable accommodations may include making facilities readily accessible, modifying work schedules. Maybe somebody with some sort of a problem can't sit at a desk for 8 hours, so maybe the person will be given an accommodation where they can work in 4-hour shifts instead of 8-hour shifts. Acquiring equipment or devices, modifying examination or training materials. Schools very often are asked to do this, give people with certain disabilities extra time, or a person to read them the work, etc. Also, these limitations are limited. These requirements are limited when the qualified individual with a disability is qualified to do the job. If the person is not qualified to do the job, well then of course you don't have to make an accommodation. You don't have to allow the person to work for you if the person's not going to be able to do the job. How do you determine whether somebody has a disability? Remember, not everybody is covered by the ADA. You're only covered by the ADA. You can only sue based on the ADA and get an accommodation based on the ADA if you have a disability. A disability is someone who has a physical or mental impairment that substantially limits one or more of his or her major life activities, has a record, and is regarding of having such impairment. Physical impairment like being blind or being wheelchair bound or something like that obviously is a disability. There was actually a case a number of years back about what if you have a disease that doesn't show up, but you have to make certain lifestyle changes based on that disease? Just that you can't do certain things because you have a disease, but it doesn't impact you at all on a day-to-day basis. And I believe the courts basically ruled that that's not considered a disability because it doesn't bother you on a day-to-day basis. What is the requirement of an employee regarding the Americans with Disabilities Act regarding disabled people? Well, first of all, employers are forbidden from asking about the existence or severity of a disability. I can't ask, are you wheelchair bound? Can you walk normally? Now, again, there's that BFOQ exception if it's something if the if the job is an Olympic sprinter and somebody is wheelchair bound. Well, I don't know if there is such thing as the job of a wheelchair a sprinter. But if a person is, if the job is a lifeguard and the person because of a disability can't swim, I mean it's common sense that the ADA doesn't protect that person. But you cannot discriminate if a person can't. If a person, for example, is wheelchair bound, but it's a desk job, it doesn't require somebody to actually walk around. Well, then you can't even ask about that when you're hiring the person in the first place. Pre-employment medical examinations are also forbidden before a job offer is established. You have to essentially give the person a job offer, and once you do that, once the person starts working for you, then you can give the person a medical evaluation. But if the person does have a disability, you have to give a reasonable accommodation. Okay, two last points for the course. First of all, we've got this idea of affirmative action. Now, affirmative action is a policy that private companies can pick up. Government policies or government jobs or schools, again, can enact these policies, but they don't necessarily have to. And that is a policy that certain job preferences, or let's say school admission preferences, will be given to minority or protected class applicants when an employer makes an employment decision. Now, that is allowed in certain cases, but it's certainly not required. Basically, what this is when, let's say, for example, you have a government contractor, and they realize that 95% of their employees are white, and that's because in the past there had been discrimination, and because of that they have this hugely white workforce and very few minorities on their workforce. Well, they might say, okay, from now on for a while we're going to start giving some preferences in hiring to minority applicants so that we will reverse the effect of past discrimination, and second of all, we will kind of make sure that our workforce is kind of a little bit more in line with the general population ratios. And that can be done. There are certain circumstances in which the Supreme Court has disallowed it. For example, when a school said, we're going to set aside 15 seats in every incoming class for people who are minorities, the Supreme Court said, that's going a little too far. You can't set aside a certain number of seats, but you can give race-based preferences. That, of course, gives rise to the question of reverse discrimination, because the whole Title VII, the whole employment discrimination rules, they apply to people who are part of the majority class just as much as they apply to the minority class. It protects black people from discrimination, but it also protects white people from discrimination. It protects Jews and Muslims from discrimination, but it also protects Christians from discrimination. It protects women from discrimination, but it also protects men from discrimination. So affirmative action plans, actions that we discussed, have been allowed based on these criteria because they are needed to reverse past discrimination and to normalize the workforce. But affirmative action plans may not have pre-established numbers of quotas, as I mentioned. And finally, majority class members, just like minority class members who are being discriminated against, can recover damages or get other remedies. And those are all the material. That's all the material we have for this course. I want to thank everybody for listening. I hope you've gained some insight into the course materials based on this video. Thank you very much. Have a wonderful day.